We're so pleased to be here for this AFCM, Arab Federation of Capital Markets workshop on the IFRS Sustainability Disclosure Standards S1 and S2. This has really become a collaborative effort. This is a half-day training that has been brought to you by a number of partners. Of course, we have the AFCM who's brought us here together. And Sally, thank you so much for all the effort of making this possible. We also are here with the IFRS Foundation. And this training was made possible thanks to support from the IFC, part of the World Bank Group, and Bloomberg Philanthropies. And of course, it wouldn't be a workshop if you weren't all here with us. So thank you to everyone for joining. Now, as our host, I'm so pleased to have with us Sally Yassin, Training Solutions Expert at the AFCM, and I'm going to pass over to Sally to give us some opening remarks. Thanks, Sally.
Thank you, Tiffany. Good morning, everyone. It is a pleasure to welcome you all to today's AFCM workshop on IFRS sustainability standards, organized in collaboration with the United Nations Sustainable Stock Exchanges Initiatives and the valuable support of partners. Allow me first to thank the UN Sustainable Stock Exchanges Initiative for its continued cooperation and support in facilitating this important capacity building initiative. I would also like to express our appreciation to the IFRS Foundation, the International Finance Corporation, and all supporting partners and speakers contributing to today's workshop. Today's topic is highly strategic for our region. Sustainability disclosure is no longer only a technical reporting matter or a voluntary corporate exercise. It has become a core element of market development, investor confidence, regulatory credibility, and international competitiveness. Across global capital markets, investors are increasingly looking for reliable, comparable, and decision-useful sustainability-related information. They want to understand how companies identify, manage, and disclose sustainability-related risks and opportunities, and how these factors may affect business models, financial performance, access to capital, and long-term resilience. The introduction to the IFRS Sustainability Disclosure Standards, particularly IFRS S1 and IFRS S2, represents a major step towards establishing a global baseline for sustainability-related financial disclosures. For our capital markets, this creates both opportunity and responsibility. The opportunity to strengthen transparency and attract capital, and the responsibility to ensure that our markets, issuers, and institutions are prepared for this new phase. At the Federation of Capital Markets, we have been closely following the development of ESG disclosure and sustainability reporting practices across the region. As part of AFCM's recent regional work on ESG and reporting, we have assessed how Arab exchanges and markets have advanced over the past year. And the figures presented today clearly shows the important progress that has achieved. So SSE membership among Arab exchanges have increased significantly. So, sustainability reports are being issued by exchanges.
Sorry, Sally, everybody's having a bit of trouble hearing you. I wonder if maybe you turn your video off and see if that helps.
Can you hear me? Can you hear me better?
I think that worked. Yeah. Thank you, Sally. Sorry about that.
I'm so sorry. I'm so sorry, everyone. So as I was saying that the membership of SSE among Arab exchanges, it increased significantly. Sustainability reports are now being issued by more exchanges. Mandatory ESG reporting has expanded. ESG guidance has become more common, and training and capacity building initiatives have doubled across the region. This is a positive and encouraging signal. It shows that sustainability is becoming more embedded in the agenda of our capital markets. However, the same assessment also shows the progress remains uneven. Some markets are already moving towards IFRS S1 and S2 readiness, particularly in the GCC, while others are still earlier stages of awareness, guidance, or regulatory preparations. Some exchanges have matured ESG frameworks and active capacity building programs, while others they still need support in issue readiness, data quality, disclosure consistency, and institutional coordination. This is why in today's workshop, it is very important. It comes at a time where the region needs to move from general ESG awareness to a more structured phase of sustainability documentation. The objective is not only to understand the standards, but also to discuss how they can be applied in a practical, realistic, and regionally relevant manner. Our markets do not all start like from the same point. Some have already adopted or aligned with international frameworks and integrated reporting principles, and others are still building the necessary regulatory and institutional foundations. But the direction is clear. The region is gradually moving towards stronger sustainability disclosure, greater comparability, and closer alignment with international standards. This is where AFCM has an important regional role to play. As a federation bringing together Arab exchanges, CSDs, clearing institutions, and wider capital market stakeholders, AFCM provides a neutral platform for dialogue, knowledge sharing, and cooperation. Our role is to help connect regional priorities with global standards, support capacity building, and encourage a common direction while respecting the specific circumstances of each market. Today's workshop is therefore not an isolated activity. It is part of a broader regional journey to strengthen sustainability disclosure, improve market transparency, and prepare our capital markets for the next phase of global reporting expectations. It is also an opportunity to exchange experiences, learn from leading practices, and identify practical steps can support implementation across our markets. So, therefore, I encourage all participants to actively engage in today's discussion, raise questions, and to make the most of the expertise that will be shared throughout the session. And once again, I would like to thank the UN Sustainable Stock Exchanges Initiatives, the IFRS Foundation, IFC, and all our partners and speakers for their valuable contribution. I also thank all the participants for joining us today. I wish you a successful and productive workshop. Thank you.
Thank you so much, Sally. And I'm very sorry to everyone that wasn't able to get a clear
I'm
understanding
really
of that.
sorry.
No worries, Sally. I could hear it fairly clearly on my end, so I think that the recording might be okay. So I do encourage everyone to take a listen to the opening remarks in case it's a little bit clear on the recording. We will share the recording on our webpage about one day after the workshop, so you can come back and watch that at any point. Now, I'm so pleased we have our dear friend, Dr. Amira Agag, with us today. She's ESG project leads in the MENA region for IFC, and as I said, this workshop has been made possible thanks to IFC, not only for helping us develop it, but also contributing their knowledge and expertise to this work. So, Dr. Amira, over to you.
Thanks, Stephanie. Good morning, everyone. Sabah al khair, bonjour, and welcome. Thank you for joining today's workshop. It is a pleasure to have you all here as we explore one of the most significant developments in corporate reporting in recent years. So, as you know, around the world, investors, regulators, lenders, other stakeholders are increasingly looking beyond traditional financial statements. They want to understand how sustainability related risks and opportunities may affect organization strategy, financial performance, resilience, and long-term value creation. So sustainability as such is becoming an integral part of decision-making and corporate governance. So I don't want to take much of your time because today's workshop is designed, to move beyond the theory. So you will examine the key requirements of IFRS S1 and S2, discuss how you can identify and assess material sustainability-related risks and opportunities, and explore, approaches to governance, strategy, risk management matrix, and targets. So this is intended to be an interactive session. So I encourage you to ask as many questions as you can, share your experiences, maybe challenges, and participate in the discussions. The diversity of perspectives will enrich our conversation and help you gain practical insights that you can apply in your own organization. So I hope you will have a clearer understanding by the end of this course, greater confidence in interpreting the sustainability or IFRS requirements, and also maybe practical ideas for implementing high quality sustainability disclosure that will support better business decision and build stakeholders' trust. Thank you once again for being here, and let's begin our journey into IFRS sustainability disclosure reporting.
Great. Thanks so much, Dr. Amira, and always a pleasure to have you here. Thanks for that great introduction. I think it'll allow me to go a little bit quicker through our housekeeping today. As you said, we really want to see your participation today. So just a few comments on how to do that. Please put all your questions in the Q&A. If you put them in the chat, they might get lost. But you can use the chat to, give some comments, introduce yourself as you've been doing, etc. Just a note of today's workshop, we are together for 3.5 hours today, and throughout you can ask questions at any time. So don't hold them till the end. We're taking your questions at any moment. We have a lot of experts with us here today to take those questions for you. We do expect your participation, and we're going to do things through what we call Mentimeter and through Zoom polls, and we also have a bit of homework for you. And for that participation, we will give you a certificate at the end. We just ask you to fill in a feedback survey. Now, those experts that are answering your questions in the background, I'm so pleased to be joined today here with our SSE Senior Specialist, Lois Guthrie. Thanks so much for being with us, Lois. Lois is an expert at answering these questions now that she's answered thousands and thousands of them through our workshops, and was a part of the IFRS Foundation herself. We also have with us, and sorry, my name is Tiffany Grabsky, and I'm the SSE Academy head. We also have with us the IFRS Foundation to really dive into the technical questions you have. We have Robert Swiatowski, who's Partnership Manager and Capacity Building. And we also have Bella Cheng, who's Capacity Building Specialist. Robert and Bella have also done thousands and thousands of work on training and question answering. So you're really in good hands here. You have great experts on this call to answer all of your questions. Now, Amira already went through what we want to get through today, but a quick overview of those learning objectives. First, we want to help you to understand the ISSB standards. What are they? But then we also hope you leave understanding how to use these standards. And finally, identifying what steps you can take to develop a disclosure plan that applies the standards. Now, to do that, we have a step-by-step program that we're going to work through. To start with, we're going to look at the module 1 there, prepare, where we're going to look at what is the case for and the purpose of sustainability reporting. We're going to look at the overall landscape and identify what is the global baseline. Then we're going to look at aligning, so setting the direction. I consider these kind of like the railroad tracks that keep you moving on, and those are the standards. So how do you apply and use these standards? And then what additional disclosures might you add to them? Then we'll move on to implementation. This is the practices and the systems that need to be in place. So we'll look at identifying, evaluating, and integrating sustainability-related financial information. And then finally, communication. What does the final format look like? The location, the timing, how to make it an efficient approach to reporting, and how to build confidence in the users of your reports. So here's a quick look at the agenda. Hopefully you did see this before on our website as well. But just to note that each module is kind of broken down. Module 2, where we go through the standards, is the longest one. But we do have a 5-minute break partway through our training to do a quick stretch and grab a coffee or a tea. I also did mention a few extra supporting materials and a homework assignment. So just to flag, on our website, you can already get all of these materials. Lois has been sharing in the chat the website you can go to, the SSE's website, where we have for this particular workshop all the resources you might need. So that includes your assignment, your homework. It includes the slides from today. So all these slides you have access to. Some additional slides are in there as well. And we also have a new FAQ page. So we've gone through the thousands of questions that we've been asked so far by running this training program for multiple years. And we've put all the frequently asked questions and their answers on our website as well. So you can access all of that already on our website. The homework assignment is to develop a draft disclosure plan for your organization using what we've used in this training program. And not to worry, we actually are going to walk you through this throughout the workshop today. So you should leave already with a good sense of what that plan might look like and how to move forward on that. This is not mandatory. A disclosure plan is not mandatory for the ISSB standards, and it's not mandatory for this course, but we highly recommend it. And we'll talk more about that later on. Just to note, we also have an SSE toolkit on this topic, which has a number of additional resources. The first one there you can see is a model guidance on sustainability-related financial disclosures. All the content we talk about today actually exists in that model guidance. So you can go back to that to, get additional guidance on any of the areas we're talking about. We also have tools on transition plans, on climate-related metrics, and a gap analysis checklist. So all of these can help you on your journey. Please make use of them. They're meant to be very user-friendly and to just help you point towards the resources that might give you more support or kind of break down how to get started on these topics. Now, I did say that we wanted to hear from you today. So I'm going to start by sharing my screen and going to Mentimeter. So Mentimeter is a tool we're going to use today in order to have a dialogue with you, to hear from you. This is completely anonymous, so you can write in there whatever you want to do. You can join either on your phone, just pointing it at that QR code on the screen, or you can use the link in the chat that Lois just shared. Or you can go to mentimeter.com and type in that code 88630155. And then you can answer our questions as they come. We'll come back to this Mentimeter throughout our training workshop. So I recommend either just keeping it open, like on your phone in a browser, or if you're on your computer for the Mentimeter, just keep it on a separate browser and you can just keep coming back to it. Then you don't have to rejoin every time. It'll save you a bit of time. So I see that we have 25 of you who've come in already and are starting to answer questions. Why you joined today? One of you did the cool face. So yeah, it is cool to learn. I like that one. But most of you say knowledge. That's really great. So you're here to gain knowledge, capacity building. You say it's relevant for your work, to have a better understanding, upskilling. These are all really good. So great to see why you're here. We want to mostly make sure that you're able to use the Mentimeter at this point. So if you are having trouble access it, please just let us know in the chat. Lois can help you out to be able to join. Great. So now I'm going to move to the next question, which is we want to know how much you know already. How comfortable are you with this topic? The first one, you can use the slider to tell us how comfortable you are from not comfortable at all. This is something you're really unsure about, to super comfortable. That's something maybe you do all the time in your job anyway. So the first being, how comfortable are you with explaining to team members what the ISSB is? Do you know what it is? Are you able to explain it to someone? The second is how comfortable are you with using the ISSB standards? And then finally, how comfortable are you in identifying what steps can be taken to develop a disclosure plan applying the ISSB standards? Great. So it looks like our comfort levels are on the lower side, which is no problem whatsoever. We're here to build those up to make you feel more and more confident on this topic. Great. I'm glad to see that a lot of you are okay. Some of you are very comfortable, and that's great. And I hope you share with the rest of us how it's been working on this and maybe some obstacles that you've been having. I'm going to go back to our slide deck now, and we're going to continue on with the next topic here. Okay, so to start off with, I'm going to leave this disclaimer up for a moment for you to review. But just to be clear as to how we're using the examples today, they're very simply to help add some color to what we're talking about. So sometimes it can help to see a real example to put into practice the discussion. However, the example should not be seen as, the best way or even the right way for your company. Remember that each company has unique circumstances and should do what is best suited to those circumstances. You can, however, use these examples as inspiration as you get started. Now, let's dive into the first unit, which is prepare. Here we want to build a solid foundation of knowledge, and we want to build on what you already know, like the standards are built on existing knowledge and frameworks. So in this first unit, to build a solid foundation, we would like to cover three important aspects. We're going to look at the purpose, the case for, and purpose of sustainability reporting, the landscape, how the reporting landscape has evolved, and we'll look at the global baseline. So let's get started first with purpose. And to do that, I'm going to do a Zoom poll with you. Just give me 2 seconds while I get this up. There we go. So it should launch now on your screen. You should see a little question there and a few options to choose from. And it's asking you, what are your reasons for disclosing sustainability related information? Is it for regulatory requirements, for sharing your management's objectives? Is it peer pressure, social expectations, perhaps? Maybe investor interests or investors asking for this information? Or maybe you're not disclosing sustainability related information yet, so there is no particular reason for disclosing it. And you might have another reason, and I'd love to hear in the chat what that might be. I'll just give you a second to fill this in. Okay, let's end it there. And it's good to see that there's actually a wide range of reasons here. So regulatory requirements is sure up there, but investor interest as well. What I really like to see is a lot of you are using it to share your management's objectives, which is a really good objective because that means that you're coming about it the right way, not just a tick box exercise. Great. So with that, let's move on. So let's look at, remember, we're setting the stage here of the panorama. So we've seen a lot of growth in investor commitments. There's been more than 5,000 signatories now, representing more than 128 trillion US dollars in assets under management by signatories of the principles for responsible investment. So what do you think is driving this interest in the investor community? Now, what I think is important to highlight is a key driver behind the demand is indeed the potential financial effects of sustainability related issues and the growing recognition that for companies, this is highly relevant to long-term value creation and strategic resilience. So the data on the screen is from a recent study of institutional investors conducted by HSBC, the bank, where they found that the top driver for investors to incorporate climate change and environmental issues into their investment strategies was actually the perceived impact of these factors on long-term performance. You can take a closer look at this study in the slide handout, but now let's look a little bit closer on financial effects before we move on. So it's important to remember that today we're talking about disclosing financially material sustainability related information. While we will discuss more in depth in this workshop what the word material really means, we want to be clear from the start what sort of financial effects investors are looking to have more information on. So let's start with the effects on a company's performance, which is often seen in the statement of profit or loss, showing income or revenue and expenditures. Sustainability related risks and opportunities can have a financial effect by changing the revenue mix or the total revenue of a company if demand for products or services change, for example, or product capacity is disrupted. We could also see substantial changes in expenditures if, for example, operating costs increase due to energy prices increasing, or a need for greater R&D expenditure to capitalize on sustainability related opportunities, or other costs associated with deploying new practices. And we can also see effects not just on the financial performance, but also on the financial position. You'll probably hear us talk today a lot about effects on a company's financial position. So let's look at what that means too. We can often see a company's financial position on their balance sheet, also known as a statement of financial position. So for example, a company may experience changes to certain assets or liabilities due to climate or sustainability issues. And we might see changes to their portfolio value, or we might even see write-offs of certain assets that are damaged or that need to be repriced. Another financial effect that could be documented is changes to financing the cost of capital. That can include, for example, equity valuations that are impacted by climate risk, as well as making use of financing structures such as green bonds or social bonds. Now, before we move on to the next module, I just want to flag two important aspects of sustainability-related risks and opportunities, which are really essential for understanding of them in our disclosures. Before we jump in, it's worth noting that the ISSB standards are designed to help a company identify and communicate its own specific sustainability-related risks and opportunities. But let's look for a moment at the global picture to help us understand these two topics. Firstly, what you can see here from the latest Global Risk Perception Survey of the World Economic Forum is that risks evolve over time. Sometimes that may pose, or something that may pose as a significant risk 10 years from now may not be high on our minds today. So what's important for our disclosure is that if we're preparing for risk that we're expecting to arrive in 5 or 10 years, we may have to invest in that today or start new practices today. So that means that we may have financial effects much early on. So let's keep in mind this evolution of risks over time. Great. So another important aspect of sustainability-related and climate-related risks is that they're all interconnected. This is from the same report. And many people think that, for example, the two ISSB standards are separate standards. We have S1 and S2, but really they work together because all climate-related risks and sustainability-related risks are really interconnected. So with that in mind, to kind of set the scene, I'm really pleased to pass over to my colleague Lois, who's going to set the landscape of where we are on sustainability disclosures now. Over to you, Lois.
Thank you, Tiffany. Hello, everyone. We heard from our opening speakers and from Tiffany about why sustainability-related financial disclosure is important. And now we're going to look at how the standards have been developed within the landscape of existing reporting standards and frameworks. But before we do, may we ask you a question via Zoom? And that question is, what standards or frameworks are you currently using for your sustainability disclosure? You can select all that apply. Are you already using IFRS S1 and S2, the standards we'll be talking about today? Are you using the Global Reporting Initiative standards, the Integrated Reporting Framework, standards set by the Sustainability Accounting Standards Board, the recommendations of the Task Force on Climate-Related Financial Disclosures, regional standards such as the European sustainability reporting standards, possibly not so much for this audience, or any others. And if there are others, please let us know in the chat. I'll give you a moment to think about that and just mention to Tiffany that I can't see the progress of the Zoom poll being completed.
Sorry, Lois, we're at 57%. It's because I didn't make you a co-host, but you are now
that's
a
all right.
co-host. So you should be able to see it soon, but I'm going to end it and share the results.
Okay, lovely. Thank you, Tiffany. Thank you. So yes, let's have a look. There's quite a lot of different standards being used here. Majority, the Global Reporting Initiative, and then 45% of those that have answered already using IFRS S1 and S2. Some people using TCFD and SASB, and those that are could be quite familiar with what we're going to tell you in this webinar. So thank you very much for sharing that with us. And we'll head back to the presentation now. I hope you can all hear me okay. Let me know if not. Let me know in the chat. Good, thank you. So let's move on to look at the organization that actually developed the IFRS sustainability standards. The IFRS Foundation is a not-for-profit public interest organization that was established to develop high-quality, understandable, enforceable, and globally accepted accounting and sustainability standards. The foundation hosts two independent standard setting boards. We can see at the bottom of the screen here, the International Accounting Standards Board that was formed in 2001 sets financial accounting standards, and they are in place in over 160 jurisdictions around the world. The International Sustainability Standards Board was formed in 2021 and released its first two standards, IFRS S1 and S2, in 2023, following a strong market demand for its establishment. Because these two standard setting boards work in the foundation together, they can ensure that their standards complement each other. The work of the standard setting boards is governed by trustees, and they are in turn accountable to a monitoring board of public authorities. So how did these standards come to be? Well, you'll see on the screen here a lot of different logos you'll probably recognize, and all of these organizations have contributed to the evolution of sustainability reporting. They all have a lot in common, and although we see many different organizations represented here, the main message to take from this standard is a picture from this slide is a picture of harmonization and simplification. Most of the organizations are focused on meeting investor needs for sustainability information, except GRI, which meets the information needs of a broader range of stakeholders. Some of the organizations represented here, their work has been consolidated into or has become the responsibility of the IFRS Foundation. So the Climate Disclosure Standards Board, Integrated Reporting Framework, and SASB have all been consolidated as organizations into the IFRS Foundation. The TCFD's work has now concluded, but the content of their work is represented in the standards, and the IFRS Foundation monitors climate-related reporting. The disclosure-specific materials of the Transition Plan Task Force are now looked after by the IFRS Foundation and are represented on their Knowledge Hub. CDP has aligned its climate questionnaire with IFRS S2, and the IFRS Foundation is working very closely with GRI to ensure as much alignment as possible. So all the arrows and that narrative shows that we have a picture of harmonization and simplification here. Let me ask you another question now via Zoom, and that is, to the extent that differences still exist between reporting standards and frameworks, why do you think this is? You can select all that apply. Is it because they have different reporting objectives, different scope in terms of the companies covered or the subject matter? They use different definitions and wording. They have different materiality focuses, or is there some other reason? And if you think there is, please do tell us in the chat. Let's give you a moment more to think about this. I'll share the results with you now. And actually, you're all right because all of these answers are correct. But I would say, as many of you have indicated here, the main reason for differences is that there are different reporting objectives in that, and those objectives relate to the audiences that the information is designed for. So the ISSB very much focused on satisfying the information needs of investors. Scope can also be different. And so if you think of GRI, they look at risks, opportunities, and impacts, whereas the scope of the ISSB standards is more focused on risks and opportunities. So well done for answering that correctly, and thank you for your participation. Moving on now, those of you familiar with TCFD will probably see that the ISSB standards are based on TCFD's work. And as we just mentioned, TCFD has finished its work now. But TCFD is a good example of differences between different standards. So the S2 uses different wording from the TCFD's recommendations in some cases, but to capture the same information. So different words, same meaning. In some cases, S2 requires more detailed information than TCFD did. And that might be, for example, where ISSB asked for more information about the use of carbon credits to satisfy greenhouse gas emissions reduction targets. And S2 requires more additional requirements and guidance. So an example there that we'll come on to look at is that S2 requires companies to consider sector-specific topics and metrics for their disclosures. So the ISSB's main objective was to set a global baseline for sustainability-related financial information that enables comparable and consistent sustainability disclosure across global capital markets. And the Foundation is working with jurisdictions around the world and other stakeholders to achieve this. But what would happen if regulators or stock exchanges wanted to require companies to disclose further information that is in addition to the information requirements set out in the global baseline represented in the ISSB standards? Well, they can do that by adding their own building blocks of requirements that are tailored to meet the needs of the regulator or stock exchange in a particular jurisdiction or region. And those additional disclosures can be required as long as the information is presented in a way that does not obscure the disclosures required by the ISSB standards. So what could such a building block look like? Well, these building blocks go beyond the remit of the ISSB standards and could include the sort of information that GRI requests, such as information on impacts, or jurisdiction or region-specific information relevant to investors. So taking this building block approach reduces the need to duplicate information by having that globally consistent baseline of disclosures for capital markets while still allowing regulators and others to ask companies to report other types of information. Now, just to let you know briefly, there's been global backing for this approach, the baseline represented in the standards. The International Organization of Securities Commissions has endorsed the ISSB standards and asked their 130 members to consider how they can incorporate the ISSB standards into their regulatory frameworks. The International Account Auditing and Assurance Standards Board has developed assurance standards for sustainability information that really supports the disclosure and authenticity and veracity. As part of the ISSB's regulatory implementation program, the foundation is supporting multiple jurisdictions and market participants with their planning and preparation for voluntary and mandatory adoption. So we're now going to hand over to our colleague Bella at the ISSB, and she's going to start telling us about the standards in more detail.
Thank you so much, Lois. Yes, let's continue with the slides. Now we've talked about the business case and the market case for sustainability reporting, the evolution of the landscape and how it is being simplified and rationalized. Now it's time for us to introduce IFRS S1 and S2. Okay. As we start, it's important to know that there are some key terms that should be understood. You can find the definitions in your handout, but I wanted to briefly mention them here. First of all, we will be saying the phrase sustainability-related financial information quite a lot. This can be information about a broad set of issues, including climate, nature or biodiversity, human, social, or others. In terms of the definition, sustainability-related financial information is information about a company's sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. And what are sustainability-related risks and opportunities? They are those that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital. It could affect the company's prospects. We will also often refer to general purpose financial reports, which includes a company's financial statements and management commentary. You may know this as a management report, management review, management discussion and analysis, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we use this generic phrase throughout. Here we have just summarized the key points of each term, but you can also refer to S1 for fuller definitions of each of these phrases. So for anyone familiar with TCFD, will recognize the same four core pillars or content areas for the SSB standards. These are governance, strategy, risk management, and the metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the four content areas today, and I encourage you to download the standards as part of your homework assignment. So this is the slides for IFRS S1. So to all the preparers listening, let me start by saying don't be afraid. Yes, there is a lot to understand, but you might be surprised that some of the detail is familiar. And for the accountants listening, you too will be relieved to see many of the conceptual foundations developed by the IASB in the ISSB standards. So the IFRS S1 general requirement sets out general requirements for the content and the presentation of material information about sustainability-related risks and opportunities. And if you are familiar with TCFD, you will see the same architecture applied through all the standards. And for matters other than climate, S1 asks preparers to refer to and consider the applicability of the SASB standards and other sources of further guidance to identify sustainability-related risks and opportunities and identify material information about them. The SASB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. And finally, the standards can be used in conjunction with any accounting requirements. Okay. Oh, sorry. Yes, for S2 is climate-related disclosures. So as I just introduced, the scope of S1 is all sustainability-related risks and opportunities. And the second set standards S2 focuses on climate disclosures. So the requirements of S2 includes it fully incorporates the recommendations of TCFD, and it sets out the requirements for a company to disclose material information about its climate-related risks and opportunities. And it also requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, these include both physical and transition risk, which we will come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and GHG emissions. And preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2, such as the SASB standards. These are organized by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. So S1 and S2 are not standalone standards, so they are a package and must be applied together. Even when a company is reporting only on climate-related risks and opportunities, the company must apply both IFRS S1 and S2. This is because IFRS S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. Okay, so next let's consider some of the conceptual foundations that underpin the SSB standards, which might be new to anyone without an accounting background. These concepts help understand how best to disclose information in order to meet the requirements of the SSB standards. So to start with, companies must fairly present a complete set of sustainability-related risks and opportunities. And for a fair presentation also requires disclosures to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. And the reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another very important concept is connected information. We saw earlier when Tiffany explained how different risks are often interconnected. The SSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between disclosures in the four content areas, and connections between sustainability-related financial disclosures and the main financial statements. So this is a slide for an example. So over to you, Lois, to go through the example.
Thank you, Bella. And as this is our first example in the webinar today, I just want to remind you of the disclaimer that Tiffany showed earlier, which is just that any examples we show you today are designed to inspire you and illustrate certain things. They're not intended to be interpreted as best practice. They're just examples for inspiration. And this one comes from a company called BHP's 2024 annual report, and BHP is a mining company. And what we see in this example is how information is connected. The extract illustrates connections between the company's decarbonisation strategy, its financial results, and other corporate processes. It describes the impact of the company's climate-related risk assessment and climate scenario analysis on the company's business and allocation plans. So in the first paragraph, the company tells us that climate risk assessments and scenario analysis have been undertaken and that they are integrated into and connected with the company's strategy and treated as a sensitivity in their capital allocation process. So you can see there connections and alignment between the company's capital allocation plans and the rapidly decarbonizing global economy it anticipates. In the second paragraph, the company tells us that some assessments are still in progress. This is a good example of transparency. And those assessments in progress are to study the effect of future climate-related risks on the company's operations, productivities, and costs, in particular, physical risks. Those results are going to be used to inform and therefore connect with the company's risk management, corporate planning, controls, and adaptation measures. The light grey text at the bottom of the extract shows connections to further information on the impacts of climate risks on operational activities, greenhouse gas emissions across the value chain, on the financial statements, and production, revenue, and expenditure. So we'll hand back to Bella now for more on the standards.
Thank you so much, Lois. Yes, after an example, so let's do a quick Zoom poll to test what you have learned. Okay. So it's a question about the conceptual foundations and what information should be considered for connected information. The connections between governance strategy, risk management, and metrics and targets, or connections between sustainability-related financial disclosures and financial statements, or connections between sustainability-related risks and opportunities. Okay, I've already seen half of them have answered these questions. Okay, so I'm going to end the Zoom poll and share the results. Well, yes, well done. The correct answers is all of them are correct. So just to remember that when I introduced the conceptual foundations, it's one of the important concepts is connections, and all of these three aspects are related to the connected information. So now let's continue with the standards. Yes. So the standards are built on the concept of materiality as defined by the IFRS Foundation. We are going to go into this in more detail later, but just to highlight that we'll be referring today to material information, which is information that if omitted, misstated, or obscured could reasonably be expected to affect investor decision-making. During the SSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards and the application guidance published in 2023, a number of educational materials, resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. And the SASB standards were used to create the industry-based guidance accompanying S2, and the FSA credential was also updated with more plan to come. I should also note that the IFRS Foundation's capacity building program, which was launched at COP27, is a key part of our support to preparers, and the SSE training initiative is one of our most important deliverables. Okay, so it's time for another Zoom poll. Yeah. This one is designed to test a really important principle in IFRS S1 and S2, how to approach disclosure on topics where the IFRS hasn't yet issued a topic-specific standard, which water is a good example of. So the question is, water is a vital input to your business, but the ISSB standards do not currently have a specific standard on water. What do you do? So are you going to do not disclose anything about water or consult the sources of guidance listed by SSB, or engage a consultancy to help, or copy your competitors' reporting? Yeah, just give a few more seconds for the others who haven't answered these questions. Okay, so I'm going to end the Zoom call now. Yes. Well, you can see the results that 79% of participants have chosen option B, consult the sources of guidance listed by SSB. Yes, you are right. That's the correct answer. Yeah, so even where the SSB hasn't yet issued a topic-specific standard, that doesn't mean companies ignore the issue if it's material. So in this question, water is a vital input to our business, which means water-related information should be material information for your sustainability disclosure. So in terms of the standards requirement, the standards allow and expect companies to look to other relevant sources of guidance, such as CDSB water guidance, including industry standards and frameworks, to identify and disclose material sustainability-related risks and opportunities. So the only correct answer is option B, but sometimes you might think that option C and option D may also be helpful. Yes. So that's the end of my part, and over to you, Tiffany, for the module 1 summary.
Great. Thanks so much, Bella. Before we wrap up the module, I just wanted to take a few minutes to review what we've covered so far. So first, we reviewed the purpose of sustainability-related disclosures, and a key takeaway we hope you leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability-related financial information. If you're not aiming to make good use of the data you're collecting to improve your strategic decision-making, you're going about this all wrong and wasting your time. So if you have operations in difficult to abate or high impact sectors, your competitors could disclose these risks and identify opportunities they're pursuing, leaving your investors wondering why you're lagging, and that might affect your equity evaluation or ability to access capital. Next, we looked at the evolution of disclosure standards, the formation of the ISSB, and the aim to simplify the landscape. Ooh, pardon me. So when you're thinking about other voluntary disclosures, you should not see them as competing with the ISSB standards, but rather building on top of them. And then finally, we introduce the standards and important concepts that you need to understand in order to use the standards correctly. A key point I want to reiterate here is that these standards and the guidance that comes with them are designed to meet the needs of investors and therefore are heavily focused on prospects that we discussed at the very start of this unit. Now, that brings us to our first activity. So after each module, we're going to do an activity together, which is really helping you set that disclosure plan for your homework. Now, for this first activity, we want to look at how will you define the objectives of your sustainability disclosures. So a few points to help you out here. First, setting the goals. Be clear on what you're trying to achieve through your sustainability disclosures or any plans to adapt them. Second is define the requirements, identify what's really required of you in order to meet those disclosure requirements. And then third, consider where you are now. In order to know where you want to go and what that plan is going to look like, you have to look at where you are now. So I'm going to move us on to another screen. I'm going to share this screen here. And we've already had a few of you answer the question, so great to see a few answers here. The first few that came in were focused on regulatory requirements, which is perfectly okay. It also makes setting those goals very easy because you can identify what is the targets you need to meet. So we see complying with regulatory requirements, complying with requirements of integrated reporting, enhancing stakeholder confidence. That's a really great answer there. Transparency, accountability. Organizational sustainability. Of course, if you're reporting this information, you have to understand it internally. You have to understand what's happening within your organization. So that's great there. Improved risk management through the identification and assessment of sustainability related risks, complying with regulatory requirements and international best practice. Good. So I think a lot of you have it clear kind of what exactly you're looking at here, building stakeholder trust, raising confidence of a company and employees, disclosing information, identifying risks and opportunities, doing better than before for the environment to look good. I think the first half of that was great, doing better than before for the environment. To look good, we need to be careful with that. If we're only looking at the surface, it's actually quite hard to use these standards in a way that's greenwashing, right? Because it's making very clear what's expected to explain in terms of how you're managing, overseeing, how you're identifying and acting on sustainability related risks and opportunities. So that what it really asks you to do is explain your processes and practices that are protecting your organization from these risks and preparing them to capitalize on these opportunities, helping investors understand what's going on within your organization to really set those practices in place. So it's actually, if you're doing it right, it's not something that's going to just be surface level. It's going to be much deeper than that. So maybe before we move on, these are all really good answers. A few things to mention. You should always consider your audience when you're working on your report. And you should definitely get stakeholder feedback as you're setting your objectives. When you set your objectives as an organization, do they meet the expectations of your key stakeholders? Of course, regulators are part of that, but also investors and other stakeholders. Also, look to the future, expect future reporting requirements, not just current expectations, so that you're prepared as these changes come into place. And aim to maximize internal benefits from the outset. As I said, we're not just here to kind of greenwash or blue wash or any other wash. What we're trying to do is help it be well understood the preparation our companies are making to make sure that we'll still exist in 2, 5, 10, 20 years. And so the benefit really is your own. It's investors want to understand that you are, on top of these things. So making sure that from the outset you're setting it up for the benefits to be achieved from this process. It can be really important, and some of those objectives should link to those benefits that you'll get there. Great, so I'm gonna stop sharing that screen and come back to our other screen here. And we're gonna continue on with our presentation since all of you seem to know what you're doing already. Great, so with that, I'm gonna pass over to Bella and she's gonna dive into the standards. Thanks, Bella.
Thank you, Tiffany. Yes, let's continue with the slides. Yeah, we have introduced the initial concepts. Let's dive into how to apply the SSB standards, taking into account additional disclosures, including any relevant geographical or sectorial requirements, as well as peer practices and your leadership's objectives. In order to understand how to ensure your disclosures meet global standards, we will look at two key concepts in this unit. The first and the main focus of this unit will be on how to apply the standards as part of the global baseline for sustainability-related financial disclosures for capital markets. Once we cover that, we will also discuss how additional disclosures fit. So to begin, let's focus on how to apply the SSB standards as the global baseline. Okay, so let's get started on the first core content area, governance. This aspect is centered on understanding how oversight for sustainability-related issues is providing in the organization through the processes, controls, and the procedures that have been put in place at board or management level. For each of the core content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements, for example, as part of gap analysis. So if we look at the governance and the management requirements, we can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and the management of processes, controls, and the procedures of sustainability-related risks and opportunities? Is management responsibility delegated to a specific role or committee? And you may also ask how and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. This could include setting targets to manage sustainability-related risks and opportunities. And you may also ask whether progress against these targets links to executive remuneration. And for more information, you can make use of SSE checklist too, but remember it's not a replacement for reading and using the full SSB standards. So it's time for examples to see what we mean in practice. So over to you, Lois.
Thank you, Bella. Yes, and we're going to have two examples that illustrate ways in which companies describe their governance arrangements for sustainability. The first one is from Yara, which is a global crop nutrition company, very big company, 17,000 employees in 60 countries. In this governance model, example from the sustainability statements within Yara's 2024 integrated report, we see a highly integrated model where responsibilities for sustainability are embedded across lots of different business functions, including risk management, health and safety, environment, HR, global climate and energy. Let's have a look. I know it's a bit small on some of your screens, but I'll try and talk you through it. In the dark brown boxes at the top, right in the middle of the screen, we can see that's where the board of directors and CEO are. And you can see lots of arrows leading into and out of those dark brown boxes. The Board Audit and Sustainability Committee to the left of the Board of Directors and President, they assist the Board of Directors in overseeing the process for and internal control of sustainability reporting and material risks and opportunities. Then below that, in the light green boxes, the first one is the Sustainability Governance Team. And you can see from the arrows that they have a direct reporting line to the CFO and then further on to the Board Audit and Sustainability Committee. And they're responsible for sustainability performance and reporting, but their work is closely aligned with corporate performance and risk functions. Right at the bottom, we have the Sustainability Network, and this reviews the company's accountability processes and the systems they have in place for ESG policies, and they monitor sustainability performance, and that network is chaired by the Chief Compliance Officer. And these arrows show responsibilities and the flow of information and input between the different governance bodies in the organisation. Now, of course, there are lots of different ways in which you might express your company's governance model, and it might depend on your regulatory context as well. This is just one example. Let's have a look at another one. This is an example from Petronas, which is Malaysia's national oil and gas company and a global energy company with a presence in over 100 countries. In this example, the governance structure shows the executive, non-executive, and independent roles of the board of directors, and the three committees to which the board delegates authority, responsibility, and operations. So, climate-related matters are included in the responsibilities of all three of these board committees that we see right in the middle of the screen. The Audit Committee monitors climate-related reporting, and later in the report we see that that committee also provides assurance on the state of governance controls and compliance in relation to greenhouse gas emissions reporting. The Nomination and Remuneration Committee reviews the President and Group CEO's performance scorecard, which includes climate-related measures. And the Risk Committee's work includes looking at climate-related risk and mitigation, as you would expect. At the bottom of the image, there's the executive leadership team, and their duties include sustainability and they report to and assist the board on sustainability matters. So this is another integrated structure where responsibility for climate and sustainability are embedded across multiple functions and are delegated to those functions by the board. And a structure like this provides role clarity and accountability, promotes strategic alignment across the group, and facilitates decision-making at all levels. So we've covered governance. We're going to move on to the next core content area on strategy with Tiffany now.
Thanks so much, Lois. So great. I hope those examples made the governance section fairly clear. Let's look at the next core content area now, which is strategy. And now strategy has quite a few more disclosures to include than governance, but it's really where companies can see the benefits from sustainability-related opportunities and being prepared for those risks. So this content area focuses on understanding what the company's strategy is for managing its sustainability-related risks and opportunities. And there are three high-level areas that we focus on in the strategy content area, which are risks and opportunities, their effects, and the company's resilience. And we'll review each of these separately now in our slides. So what are some questions that you can start on this? So IFRS S1 and S2 disclosure requirements on strategy are designed to enable users of general purpose financial reports to understand a company's strategy for managing sustainability-related risks and opportunities. If we first look at the requirements related to sustainability-related risks and opportunities, these are some questions you'll want to be asking internally. So when disclosing information about risks, information required includes a description of the effects, the time horizon under which those effects are expected, keeping in mind that the financial effects can occur before the risk or opportunity materialize, or it can change over time, like we discussed at the start of this workshop. The last two questions you can see on the list in particular look at climate. So this aligns with the requirements of S2. So for example, investors also want to understand what types of risks or opportunities, and S2 requires companies to identify climate-related risks using the categories from the TCFD, physical and transition risks. Both standards include guidance to support companies as they identify and disclose material information about risks and opportunities. For example, you can use the industry-based guidance and the SASB standards, which identify many of these material areas. This can often be easier to understand with an example. So let's dive into an example here. This example is from Monde Group's 2024 integrated report. Monde Group is a multinational packaging and paper group. They have operations across Europe, North America, and Africa. In the left-hand side of this example, we can see which risks the company has identified, and how the risks align with the four key categories: strategic, financial, operational, and compliance. And the delegated risk owners is also identified here, which obviously helps us understand how they're managed. There is a lot more information about the risks throughout the report, but this is just a snapshot we pulled here. Now, climate change risks in the strategy categories are then further analyzed in the second extract we've added to this slide, and they're categorized as physical and transition risks, as well as opportunities, of course. As well as identifying the risks through evaluation processes described in the report, Mondi shows the estimated financial impact range, also the time horizons when this should occur, including differentiation between the onset of the impact and the full impact of that risk or opportunity, and also the sensitivity of the risk and the opportunities in terms of likelihood under different temperature scenarios. So really, the company has shown they really understand how these risks and opportunities could impact their organization and how they're managing that. Now, another aspect of the risk and opportunities identified as potentially affecting the company's prospects that will need to be disclosed and that Mondi did well brings us back to what was discussed at the beginning: time. So you may remember we discussed earlier that the time factor is something quite different when we're talking about sustainability related disclosures. So let's make sure we're clear on what we mean by time horizons. So the standard asks you to identify within what time horizons over which the effects of each of the sustainability related risks and opportunities could reasonably be expected to occur. So when do we see these effects? Definitions, however, of short, medium, or long-term time horizons can vary from company to company, depending on many factors. They can be impacted, for example, by investment and business cycles, or strategic planning horizons, or the life of assets, or other factors as well. But what's important to remember is that this time horizon should be defined. Because it's, not a universal definition, you need to explain to investors what you mean by short, medium, and long term, and provide, quantitative definitions. Do you mean 5 years, 10 years, 20 years, etc.? Now let's look at how you can internally discuss the effects on the business. This is a second grouping of disclosures in the strategy category. The first section of the strategy component related to identifying the risks and opportunities that could be reasonably expected to affect your company's prospects. The next set of disclosure requirements focuses on what exactly that effect is and where it's occurring in your business. To start tackling the disclosure requirements to this standard, companies might want to start asking themselves questions such as beginning to describe these effects and understanding the response planned for mitigating or adapting to these effects identified from sustainability-related risks and opportunities. Again, an example I think helps bring this to color. So let's move on to another example. This is from a global chemical producer, BASF's annual to 2024 annual report. So this illustrates some of the projects that form part of the company's sustainability strategy called Winning Ways. So the strategy includes supplying customers with products that contribute to sustainability through the use or through the reduced carbon footprint. So the company is prioritizing projects where they see rising demand from customers and willingness to pay for sustainable products, as well as transformation projects that support the company's license to operate. Amongst other things, the company is investing in renewable energies to operate their plants. So you can see that in the own production panel of this extract on your screen. So the triple S reference in the last panel, the downstream value chain, refers to sustainable solution steering to streamline the company's portfolio and support their global sustainability related targets. Now, in related commentary, the company says that it wants to achieve 10 billion euros in sales revenue by 2030 from products that contribute to the transition to a circular economy. Now, I think this example illustrates how the company's sustainability strategy affects its business model and its value chain. Connections are made between the company's strategy, its sustainability targets, its technology ambition, and the value chain and financial estimates. Now, sometimes one of the obstacles companies face when reporting on these effects is to what detail this should be disclosed. In the example we just looked at, we were showing mostly qualitative disclosures and descriptions. But what about quantitative disclosures? Now, a company is required to disclose both quantitative and qualitative information about the current and anticipated financial effects of sustainability-related risks or opportunities. However, the standard also sets out criteria for when only qualitative information is required. So, for example, using only qualitative information for current and anticipated financial effects is allowed. In one situation, if a company cannot separate the effects of a sustainability-related risk or opportunity from other effects, or another situation, if there is a high level of measurement uncertainty. Now, additionally, only qualitative information for anticipated financial effects is allowed in the instance that a company does not have the skills, capabilities, or resources to provide that quantitative information. So really using what we consider the proportionality principle here. Now, there is another example in your handout, so with a few explanations on it, so you can look at another example in your own time, but let's move to that last part of the strategy component now. The first part, remember, was looking at the risks and opportunities that could reasonably expected to affect the reporting company. Then the second part was, what is that effect? Now, this group of disclosures looks particularly at how the company is prepared for uncertainties and ensuring its resilience into the future. This really gets into the practices and processes that a company has in place to assess its own resilience and to make strategic adjustments when needed. So disclosures include information on how the assessment was carried out and its time horizon. So for climate-related developments and uncertainties, IFRS S2 additionally requires to use climate-related scenario analysis using an approach surely commensurate with the company's circumstances. It's a required disclosure that includes, one, its assessment of climate resilience, and two, the inputs and key assumptions used in that scenario analysis. Now, we're going to dive deeper into scenario analysis in a moment, but some questions you consider asking internally when starting to disclose this information is to focus on the company's capacity to react or adjust to the uncertainties as they arise, and how different scenarios are being used to test that resilience and your ability to react. But again, I think some examples help, so let's look at another couple examples here. Now, this one comes from Stora Enso. That's a Finnish and Swedish forestry product company. And it shows us in this small diagram on the top right of the slide what sales are likely to look like in 2030. So Stora Enso distinguishes between essential and growth business in this quite powerful but very small infographic. We don't have any numbers here, but we have an immediate picture of where growth is anticipated and also detail about the company's long-term vision and their recent transition, which they described as proactively repositioning the business from largely a pulp and paper company to a renewable materials company, ensuring our future for many more years to come, they say. So they give a sense of how the growth business will expand through acquisition of other companies and converting machines and through innovation. Let's take another example here from British multinational retailer Marks and Spencer's. And it comes from their disclosures about the impacts of climate-related risks and opportunities on the company's business, strategy, and financial planning. So this gives lots of information about the risks and opportunities that respond to the ISSB requirements. The first column describes the risks and opportunities. So the first is a transition risk, and it is about new environmental compliance. The second row is both a transition risk and an opportunity, and it's about the company's ability to keep pace with customer trends and preferences for more sustainable product choices. Then the next column then explains which part of the businesses are affected by the risk or opportunity. And the third column shows whether the risk or opportunity manifests over the near, the medium, or the long term. And remember, those need to be defined, what we mean by near, medium, and long term. The fourth column of the report then describes potential financial impact on the business. So note the title Q on the first line, which means the company has been able to quantify the risk. And then there's a little N on the second line, which means the company has not been able to quantify that risk. So the disclosure tells us what type of financial impact they anticipate. So for example, changes in operating costs and capital expenditure or in revenue. There's also a reference to where further information about the capital expenditure costs for risk can be found in the financial statements. And in the final column, the disclosure gives detail about the business's response to that risk, such as reviewing shopper sustainability preferences or investing in innovation and new product development, as well as the targets related to those risks. So for example, in response to the second risk, that by the end of 2025, 2026, 100% of polyester used in fashion, home, and beauty products will come from more sustainable sources. Great, so let's now do another poll. This one here, our sixth poll, asks you a quick quiz. So a company may choose to disclose only qualitative information or a combination of combined qualitative information and quantitative information about its current and anticipated financial effects when, three options here, when the company cannot separate the effects of a sustainability-related risk or opportunity from another effect. Second option is when there is a high level of measurement uncertainty. And the third is when the quantitative information sheds a negative light on the company. So in which of these situations is it okay to omit quantitative information? It was just a few slides back we went over this, so hopefully you can remember it. I'll give you just a moment here. Okay, there's about 40% of you that have answered, but I know more of you can try it out. So no worries, it's totally anonymous. Just give it your best shot and guess. You can pick any one of them you want or multiple. You can pick more than one. I'd love to get at least half of you participating in the poll. Okay, one more can fill it in. I'll wait for that last. There we go. We got one more person filling it in. Great. Thanks, everyone. Please, we do appreciate your participation. It also makes it a little bit more fun for you, hopefully, to really push yourself a little bit and check your knowledge acquisition here. So well done, everyone. So you are listening. The first two, yes, are indeed correct. So as we covered, these are both criteria set out in the standard for when only qualitative or combination of quantitative and qualitative information is permitted. However, option C is not correct because, of course, it's important that our disclosures are balanced. So if we do not have, or if we do have quantitative information about possible material negative financial effects, it's important that we provide this transparently to our investors. And indeed, we saw this was the case in the disclosure examples we just discussed, where companies are disclosing financial effects for both risks and opportunities, but they also discuss their resilience and how they're prepared for that. Great. So with that, we're going to move on to some climate considerations, and I'm going to pass to Lois to take you through that. Thanks, Lois.
Thanks, Tiffany. Yes, so the governance requirements we've talked about are very similar across S1 and S2. But when it comes to strategy, there are some specific requirements in S2 that apply to climate disclosure. So let's have a look at those in a bit more detail. Well, first of all, S2 requires a company to refer to and consider the applicability of industry-based disclosure topics. Now, you will find this in the industry-based guidance on implementing S2, which is one of the suite of documents that accompanies the standards. So I'll give you an example. S2 says that when considering their risks and opportunities and their metrics, companies must refer to this industry-based guidance on implementing S2. So if you were in the agricultural products industry, for example, there would be in that guidance specific questions about ingredient sourcing and in particular things like whether you source ingredients from areas of high water stress. It might ask you whether your scenarios include those that are specific to crop models and how you use crop insurance, that type of thing. Secondly, S2 asks for information on where in the company's business model and value chain risks and opportunities are concentrated. So we've seen some examples about physical climate risk, and you might consider whether you have any particular physical assets that are vulnerable to physical climate risk. Thirdly, S2 asks for, in describing the effects of climate-related risks and opportunities, how a company responds to or plans to respond to the identified risks and opportunities. So a response might be to devise a transition plan or to create climate-related targets. Then, in providing disclosures about the current and anticipated effects of the risks and opportunities on the company's finances, S2 sets out criteria for when quantitative and qualitative information is required. So recognizing that it can be very difficult to provide quantitative information, disclosure of qualitative information is permitted under some circumstances. So when a company cannot separately identify the effect of a risk or opportunity, or where the level of measurement uncertainty is so high that the information just wouldn't be useful. So the S2 recognises that preparing disclosures on the anticipated financial effects of climate-related risk and opportunity is difficult, and it therefore says that a company is required only to use all reasonable and supportable information that is available at the reporting date without undue cost or effort, and to use an approach that's commensurate with the company's circumstances. And we'll come back to this a bit later. As we've heard, scenario analysis is to be used for assessing the company's resilience to climate-related risk and opportunity, but bear in mind that S2 does not tell the company which scenario or scenarios to use. That is for the company to determine. Having determined having its assessment on the extent to which it is resilient, S2 requires information about this, including which scenarios were used, what's the company's capacity to adjust and adapt its strategy and business model over time to remain resilient or become more resilient, and what are the significant areas of uncertainty considered by the company in its assessment of resilience. So I mentioned that one of the responses a company can have to climate-related risk is to develop a disclosure plan. So what is a disclosure plan? It's defined in S2 as an aspect of a company's overall strategy that includes targets, actions, or resources for the transition to a lower carbon economy, including, for example, greenhouse gas emissions reductions. So what is a transition plan like? What would be its characteristics? Well, first of all, it should align with the company's strategy, business case, business motivation, and the decarbonisation levers that are most economically and technically feasible. for the company. And the reason for this is that the transition plan is part of an aspect of the company's overall strategy and should therefore align with it. Secondly, a transition plan could be aligned with science, including what science says about requirements for net zero to be achieved, or how carbon neutrality or Paris-aligned goals are explained in terms of science. A transition plan will, of course, operate over a particular time period, and goals should be set that are long-term goals in accordance with the period of the plan. And they should have clear mitigation and adaptation activities associated with them and should include interim targets and milestones to monitor progress. The transition is uncertain, of course, and therefore the transition plan should be transparent about the dependencies, risks, and challenges of being able to execute the plan, and should also explain how any residual or unabated greenhouse gas emissions will be treated. The transition will proceed in different ways for different sectors, and therefore sector-specific pathways could inform the development of the company's transition plan. And we're going to have a look at some resources that are available for understanding different sector-specific pathways in our next slide. And finally, the readers of the transition plan will evaluate it and consider whether it has the hallmarks of credibility. And in the next slide, we'll show you where you can find those in resources. Now, there are loads and loads of resources about transition planning, far more than we can mention here. But the triangle on the left is simply designed to show that the resources are all designed to support each other. So we see the disclosure requirements at the bottom of this triangle in the IFRS standards. Then others, like the Glasgow Financial Alliance for Net Zero, have produced resources, as have the Transition Plan Task Force, that support the development of a transition plan that you will make disclosures about in response to S2. So let's have a look at some of these resources. First, we have the ISSB's own guidance on transition planning. So this was it's quite new, just produced last year. It's called Disclosing Information about an Entity's Climate-Related Transition, including information about transition plans in accordance with S2, full of really good information and examples. Secondly, on this screen, we have the SSE's own model guidance on climate-related transition plans, and there's a bit more practical guidance in there, more than on disclosure. But what you will find in an appendix there is a list of the hallmarks of a credible transition plan. I mentioned earlier, sectoral pathways can be very useful for companies considering how the transition might unfold for their own sector. And GFANZ, the Glasgow Financial Alliance for Net Zero, amongst others, have produced sectoral pathways to help specific sectors. And finally, now the responsibility of the ISSB, the Transition Plan Task Force disclosure framework, and other materials are available on the ISSB's Knowledge Hub now. So loads of resources to help. Now we're about halfway through our webinar now, so you'll be glad to hear we're going to have a short break. So please make yourself a nice drink, have a stretch, think of any questions you'd like to ask us. We'll play you some relaxing music and see you back here in 5 minutes. Hmm. Hello, everyone, and welcome back from the break. Hope you had a chance for a stretch and a drink, and you're ready for the next part of our session. So, we're moving on to the third core content area now, which is risk management. And this category of disclosures focuses on enabling investors to understand a company's processes for identifying, assessing, prioritizing, and monitoring sustainability related risks and opportunities, and whether those processes are integrated into the company's overall risk management processes. So, what sort of questions might you need to ask to prepare for making disclosures in this core content area? Just to let Tiffany know, I'm clicking forward on the slides, but they are not moving forward. Ah, here we are. Thank you. Questions to evaluate risk management. So in the strategy area, do you remember we were asking we were looking at disclosures about the risks and opportunities that a company had identified. Well, in this particular content area, we're looking at the processes used for that identification. So you need to be thinking earlier about what processes and policies are being used to identify, assess, prioritize, and monitor risks and opportunities, and to what extent are they integrated into the company's overall risk management process? What types of inputs and parameters do you use for risk management? What sort of criteria do you use? Is it just probability or also nature, likelihood, and magnitude of risks? What has changed since the last reporting period in terms of your monitoring or management of risks? Let's have a look at an example to bring that to life. Just wondering why my forward clicking process is not working well. Sorry about this.
Sorry, Lois. I'll change it on my end. Not sure why.
Oh, thank you. Thanks, Tiffany. So this example is from BMW, a German car manufacturer, as you know, from their 2024 group report. And they describe their risk management process here, both in words and in a diagram. And there's a lot more information in their report. This is just an extract. Interesting to note that they report their risks and opportunities for the current and the subsequent financial year. So turning to the process as summarized in the diagram, around the edge of the circle, we can see the word appropriateness. And this refers to appropriateness in the context of the risk culture that's embedded in BMW's core values. And effectiveness, we also see that word in the dark blue circle that refers to effective management of risks and opportunities. And in the little inset text we see there, BMW actually says that effective management of risks is the foundation of their business success. So you can see how important the process is. Down the left-hand side of the circle, you can see internal control system and group compliance, and they form key interfaces with the risk management system. So the process is not the responsibility of the risk department alone. Risk management is steered by a centralized risk management function, but it's decentralized within different networks to some extent. So what does the process itself involve? Well, that's in the light blue circle in the center there. It involves early identification of the risks, the analysis and evaluation of them, using appropriate risk management tools, including measures taken for the risk management. It involves monitoring and assessment and reporting, of course. And once the process is underway, the material risks are reviewed by the Risk Management Steering Committee. We can see in the white circle to the right. That's chaired by Group Controlling, and any material risks are then reported to the Board of Management and the Supervisory Board's Audit Committee. So you can see the link there between different departments and to the board as well, to the governance structures. Let's have a look at climate-specific considerations on risk management. In S2, and would be grateful for Tiffany's help. Yes, thank you, Tiffany. S2 requires information about the input parameters that are used to identify risks and whether and how scenario analysis has been used to inform risk identification. Strictly risk scenario analysis is for resilience assessment, but it can also inform your identification of risks, of course, and similar applies to opportunities. In S2, we actually have a definition of climate-related risk based on TCFD's work. There are two types of climate-related risks, and this helps you to understand what you should be evaluating when you set out on your risk management processes. First of all, transition risks arise from efforts to transition to a lower carbon economy, and they are often categorized as policy, legal, technological, market, and reputational risks. And you see some examples in the center of this table. They could include increased pricing of greenhouse gas emissions, more reporting obligations, exposure to litigation, costs of transitioning, associated with lower emission technologies, changing customer behavior, uncertainty in market signals, all sorts of examples of transition risks. Then the other type of risk is physical risk. And these are subdivided into acute risks that arise from weather-related events such as storms, floods, droughts and heat waves, which unfortunately are increasing in severity and frequency. Even in the UK, we've had a heat wave here. And chronic physical risks arising from longer term shifts in climatic patterns. Excuse my phone ringing. And these include things like increases in rainfall, changes in biodiversity, changes in soil productivity. So in both cases, these types of risks can give rise to financial effects, affecting a company's cash flows, access to finance, cost of capital, and those financial effects can be felt over different time horizons, short, medium, and long term. Similarly, in S2, we have a definition of climate-related opportunities, which refer to the potential positive effects for a company arising from the transition to a lower carbon economy. So, for example, these could include efforts to mitigate and adapt to climate change, such as using innovation, improving resource efficiency across the whole of the value chain, changing to lower emission sources of energy, supporting policy initiatives that encourage climate opportunities to be optimized, improving processes and technologies, looking at different sources of energy, accessing new markets, and so on. And again, these can have financial effects that are felt over different time horizons. Let's have a look at an example from the RS Group, which is a UK-based distributor of electrical and industrial equipment, and they have global operations. This is from their 2024 annual report. So earlier in the report than we see in this extract, the company has analysed their climate-related risks and opportunities using their processes, and they've identified 10 principal risks, one of which is climate-related transition and physical risks. And this extract is just about some of the physical risks. So the most significant physical risks relate to the impact of extreme heat on their distribution centres, and that's explained on line 1 of this table. And they also experience risk from the impact of extreme weather on their physical assets and disruption to their customer supply operations. The little red wheel icons show how these risks have strategic effects on their operational excellence and their strategy generally. And they also use icons to show which of their stakeholders are most affected by these risks. Further on in the table, you can see that the company describes the risk. They tell us who the owner of the risk is, what metrics they use to monitor the risk, and then in the final paragraph, they tell us what activities they're undertaking to manage the risk and plan for the future. So this includes capital investment, business continuity planning, and so on. So just an extract there about physical risks. And we're going to turn back to Bella now, who's going to take us through the last core content area of the standards.
Yes, thank you, Lois. Yes, we will now spend some time reviewing the disclosure requirements on metrics and targets in more detail, the final core content area of the standards. Here, disclosures are intended to enable investors to understand how the company is performing with respect to its sustainability-related risks and opportunities. Okay, so let's start with metrics. Requirements on metrics are designed to enable investors to understand the company's performance in relation to its sustainability-related risks and opportunities. So preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology. What is the method of calculation? What were the inputs? Are there limitations and what assumptions are involved? And let's move to targets. Requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals, as well as any targets it is required to meet for regulatory purposes. So disclosures include whether they are qualitative or quantitative, and whether it is set voluntarily or by law or regulation. And disclosures also include the metric used to set the target and to monitor progress toward its achievement, and also the baseline period from which progress is measured and the period to which the target applies. What are the milestones and the interim targets? If there have been any revisions to the target, together with an explanation about the revisions. So here is an example from CLP. I think it's linked to the metrics and targets. We can see what we mean in practice. So over to you, Lois, for the example.
Thank you, Bella. Yes, this is an example from CLP, which is one of the largest investor-owned power businesses in Asia Pacific, and it aims to be a leading responsible power provider. This is an extract from its 2024 sustainability report, and it's about their metrics on waste management and material use. Now, you'll have noticed that many of the examples we've showed you up to now have been about climate, but here we have an example about another sustainability matter, waste management and material use. And remember that S1 asks companies to provide information about all sustainability related risks and opportunities and material information about them. So here we see the company's metrics for 2024 on waste management and material use, including the percentage of pollution the company reduces through recycling and removal activities. Now, in the narrative, in this extract, we also see how these metrics are connected to the company's overall strategy on achieving the circular economy and minimizing its waste. Now, also, we've talked about the fact that ISSB currently only has a standard on climate. So what do we do when there is no standard for calculating metrics on waste management and material use? Well, This company has conformed with what the ISSB standards recommend, and they have used the SASB standards and GRI frameworks for the calculation of their metrics. As well as providing us with the metrics, they're telling us about their progress compared with the 2021 baseline. And yes, so what we see is metrics and targets here and progress towards targets. So hand back to you now, Bella, for more on metrics and targets.
Thank you, Lois. Let's talk about some of the climate-specific considerations for disclosures on metrics and targets. In relation to metrics, IFRS S2 requires a number of specific disclosures, including disclosure of industry-based metrics relevant to a company's business model and activities. And the disclosures also include additional disclosures on GHG emissions, including separate disclosures for the consolidated accounting group and associated joint ventures, and information about the company's financed emissions. In addition, S2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 GHG emissions disclosures. While S2 doesn't explicitly require a company to disaggregate its GHG emissions disclosures by the constituent gases, S1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. I'd like to remind everyone that you can access more information on climate metrics in the SSC training tool on this topic. We will share the link in the chat, and you can also find it on the SSC's website. As for metrics, there are some climate-specific disclosure requirements in S2 for targets as well. For example, S2 requires disclosures about how the latest international agreement on climate change has informed the target, and whether the target has been validated by a third party. S2 also requires disclosures of more detailed information on GHG emissions targets, including additional information about any planned use of carbon credits to achieve a company's net GHG emissions targets. And S2 also includes additional requirements to disclose information about the approach to setting and reviewing each target, and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. Questions on GHG emissions often come up in questions on metrics and targets disclosures, so we wanted to address some of these briefly. And for those who might not be familiar with the different scopes, I would like to briefly introduce Scope 1, which includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from your company's facilities or vehicles. And the Scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And for Scope 3, they are all other indirect emissions that occur in the company's value chain. And S2 requires a company to disclose its absolute gross Scope 1, 2, 3 GHG emissions in accordance with the GHG Protocol corporate standard, unless a jurisdiction requires a company to use a different approach to measurement. If a company is using a different measurement method, there is a transition relief to use that method in its first year of applying the standard. And S2 also requires a company to disclose whether and how the company is using an internal price on carbon for decision making, and whether and how executive remuneration is linked to climate-related considerations. On 29th of May of 2025, the IFRS Foundation has published educational material, which was presented in the Q&A format, detailing the greenhouse gas emissions disclosures requirements under IFRS 2, including measurement, use of the GHG protocol, and how to report scope 1, 2, and 3 emissions in line with the standard. So now I'm going to hand back to Lois for examples.
Thanks, Bella. Yes, here we have an example about greenhouse gas emissions reporting, just an extract, and it's from a company called Vale, Metals and Mining Company, from their 2024 integrated report. So we have a table on the right-hand side of the screen there, and this shows the greenhouse gas emissions broken down by scopes 1, 2, and 3, as well as comparative figures dating back to 2022 and to 2017, which is the baseline year in which the company set greenhouse gas emissions targets. You notice well that they call this a greenhouse gas inventory. Then on the right-hand side of the screen, we see a circular diagram, and this shows us greenhouse gas emissions broken down by source. So where do the emissions come from? And we can see from the diagram that mobile combustion activities give rise to the most greenhouse gas emissions by source, followed by industrial processes. To an investor or others who want to know where the emissions come from, this is useful information as well as the breakdown between the scopes. There's notes and symbols throughout this extract, and these tell us how the results have been prepared. And in this case, the inventory was prepared using the GRI's GHG emissions standard, GRI 305. In note 1, the company tells us that the inventory has been assured by a third party. And in note 2, the company tells us that the GHG emissions have been reported on a gross basis. That means before any type of mitigation or compensation, and that is indeed what's required by IFRS S2. At the bottom of the page, there's an overview of the company's long-term commitments that they set in 2017, and that the targets they have for greenhouse gas emissions by 2030 and 2050, and what progress is being made. So quite a lot of information in a tiny extract there. So let's have another Zoom poll now, and this one asks, what is the objective of metrics? And in particular, what is the objective of the ISSB's requirement to make disclosures about metrics? So the possible answers are, you can select all that apply to understand performance in relation to the company's sustainability related risks and opportunities, to understand progress against targets, and to understand the company's assumptions for the future. Give you a minute to think about that. Yes, we've got good participation now, so let's share the results. Most of you said A and B, and that is absolutely correct. Now, the reason we've asked you the question in this way is that if you read the standards, which we encourage you to do at the start of each core content area, the standard sets out the objective of the disclosure requirements. And in the case of metrics, it's to enable report readers to understand the company's performance in relation to its risks and opportunities, and to understand progress against targets. Now, it may be that the disclosures also help the reader to understand the company's assumptions for the future, and that's great. But if you want to craft your disclosures to respond specifically to the objectives of the requirements, then it's always helpful to look at what the objective is right at the start of each core content area in the standard. So well done, you understood that correctly. We're going to move on now, I think, to our next core content area. Just struggling a little bit still with the slide movement. Oh, here we are. Thank you if you did that, Tiffany. So this is about integrating other disclosure requirements that you may be required or want to make in addition to the baseline. So we'll go through this fairly quickly because we've already talked about it. We know what the baseline is. It's represented in the standard, but as we've already said, there might be building blocks of information to be added to this baseline because there are listing requirements in the jurisdictions in which you operate, or because there are policy objectives that mean that information would be helpful, like perhaps there are tax cuts or subsidies for sustainable practices and you want to provide information about that, or you might want to make disclosures that align with emerging industry practices or provide information for other stakeholders. Now, we've already talked about this as well, that the ISSB is working with jurisdictions around the world to encourage adoption of their standards. So far, 39 jurisdictions have adopted, used, or are finalising the use of standards. I think that might even have gone up by now if you have a look in the links that are provided in the slide. And if you want to know more about the approach of those jurisdictions that are contemplating or have actually adopted the standards, you can look at the jurisdictional guide that's linked on the slide there that gives you more information about that. Of course, what might happen if you're already disclosing against other frameworks? Well, in short, the ISSB has formed strategic relationships with different organizations that already have frameworks to support what they call interoperability, that is to make the standards as aligned as possible. We've talked about the fact CDP has aligned its climate questionnaire with IFRS S2. We're going to talk about the GRI in a moment. So I'll just pick up from this slide the fact that the greenhouse gas protocol is the protocol that must be used for the calculation of greenhouse gas emissions subject to certain conditions. But the ISSB works closely with the GHG protocol team, both in terms of technical updates, but also in terms of governance arrangements. So there's as much alignment as possible. The other one I'll note from here is that the Task Force on Nature-Related Financial Disclosures has a huge body of material on nature-related financial disclosure, and the ISSB is considering how it can build upon that work as it develops more materials. So the GRI and ISSB work closely together. Important thing to note here is that in June 2025, the GRI's standard setting board granted equivalence to IFRS S2 for scope 1, 2 and 3 greenhouse gas emissions. So in a nutshell, this means subject to certain conditions that conforming with the ISSB's requirements on greenhouse gas emissions will satisfy the requirements of the GRI and vice versa. And GRI and ISSB are collaborating further to ensure that there is the maximum interoperability on the development of work on biodiversity ecosystems and ecosystem services. And that's a project that the ISSB is currently working on. As well as looking at technical interoperability and alignment, the ISSB and GRI work together on certain governance arrangements. And as an example, the IFRS Foundation was a convening partner of GRI's Innovation Lab. So there's a link there to the statement about equivalence if you would like to know more information about that. Probably less important for this audience, but the ISSB also works closely with the European standard setter, the European Sustainability Reporting standard setter. Now, all I'll say here, because the European standards are under review, as you probably know, is that a high degree of alignment between IFRS S2 and the European standards has already been identified. So again, central message to take is that all these standard setters are working on alignment. There is joint guidance that the European Standard Setter and ISSB have published, which you can see linked on the screen there if you would like to know more. Now, when we did the Zoom poll at the start of this session, I noted that some of you are using the integrated reporting framework, which is great. It's now being consolidated into the ISSB, as we said earlier, and the ISSB and integrated reporting framework is quite well aligned. But the integrated reporting framework can be used to complement and support your sustainability disclosure for ISSB. It helps you provide a more holistic view of the value creation process through the governance and business model and more about connectivity. So if you'd like to use integrated reporting to support your ISSB disclosure, there's a helpful document that we show here that could get you started with that. But perhaps the most important thing is to note that integrated reporting is underpinned by integrated thinking, and this can very much enhance the quality of a company's governance. So let's do a quick Zoom poll now to see what we think of this. When you're looking at your disclosures, should your objectives consider the ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above? I can see already that you know the answer to this. So yes, let's share the results. Of course, it's all of the above. There, as we've seen from the examples and the training we've had so far, there are lots of different standards, frameworks, guidances that can be used to support your sustainability disclosure. But it's always a good idea to read the ISSB standards and primarily make sure that you're using these other sources to support your ISSB reporting. So Tiffany's going to take us through the Module 2 summary now.
Great. Thank you very much, Lois. Pardon me. That brings us to the end of that long module, but full of content. So hopefully that really helps you understand where these standards come from and how they can be used and really what they are at their core. Let's do a quick summary just to concretize all that information. So we reviewed all 4 content areas of the ISSB standards. As a reminder, it's governance, strategy, risk management, and metrics and targets. But an important thing to remember is that these do not operate in silos or separately. As we saw in all of our examples, despite having 4 separate categories for disclosure, they're certainly all interconnected. We also discussed how your disclosure might go beyond the requirements of IFRS S1 and IFRS S2. So for example, to meet different stakeholder needs or to meet regulatory requirements in certain jurisdictions or to meet industry standards. So what's important to remember when doing this is that the ISSB standards have been purposefully developed to act as a baseline, and then using the building blocks approach allows report preparers to then add additional disclosures on top. But in doing so, report preparers need to be careful not to obscure the requirements and the information of IFRS S1 and IFRS S2. So we're going to go into an activity again. I did drop in the chat the link so you can come back to your Menti. A few of you have joined it. I'm going to re-share my screen and we'll go back to that Mentimeter. So what we want to think about here are what are the key gaps you need to address in your current disclosures or internal processes? They could be either gaps in internal knowledge or skills or processes, or even gaps in the content of your disclosure. I'm going to give you guys a few minutes to take an answer. I see 62 of you have entered the Menti, so great. We've got a lot of you there thinking about what that might be, and 4 of you have answered. So I'm going to give you a little bit more time to fill that in. I see that someone first started off with a scenario analysis, and indeed, that's a couple of you have said a scenario analysis. It can sound very daunting, I think, at first, the idea of a scenario analysis, because it's all this additional information that maybe you've never used in your assessments before for your strategy. I think the key thing there is that there are a lot of resources you can use. You don't have to think through what's going to happen with the climate in a 1.5 degree scenario. There's actually already scenarios pre-packaged for you that you can use. And then you can move on to developing or tweaking them to better fit your needs. So just getting started is great. And you can use the SSE guidance on transition plans too, and metrics and targets, which introduce different tools you can use there. I see here internal knowledge. Yeah, definitely. And that's something that will always need refreshing, right? As we move through these different risks and opportunities, we need to update our internal knowledge in order to be able to really be prepared for those risks and to capitalize on those opportunities. So that should be an ongoing learning journey. But you're here already, so you're already taking your first step in that aspect. I see also governance oversight processes. Now, that's something that actually many organizations notice as they get started, but it's also something that's very clear to get started with. You can use the same, infrastructure in your governance you already have, and make sure it's clear where sustainability sits, where that knowledge is, where you need to make improvements, and you can do it on an incremental basis. And you can also explain in your reporting where you're at now and where you're looking to be in the future. Data availability and data quality, certainly scope 3 data collection, identifying metrics, defining time horizons. Great. So you all have actually identified really concrete areas that you need to move forward on, which is, I think, an easy next step because you at least know where to work on. There's lots of areas you could have identified, maybe data management, new topics you need to work on, integration into an annual report, maybe they're separate reports. Those connections, financial disclosures to reporting processes. Maybe you want to look at auditing the information or making sure you have the right controls in place. These are all really great answers. And it's the next step of your disclosure plan. Remember, at the very start, we were identifying what were our goals of our disclosure? What's the objective of updating your disclosure? What's the objective of sustainability related financial disclosures for your organization? Now you're starting to think of, where do you need to be in the future? What do you need to start enhancing and working towards? What is the chart forward for you? So these are all really good answers. I think you all have a great next step on your disclosure plan. Great. Maybe before I leave on, just look at a couple more here. Oh, there we go. Pairing the company services with the environmental impact. Sure, great. And more clear identification of roles. Define time horizons, setting clear targets and metrics, integrating them into the overall company's strategy. Well, that's a really good next step. It sounds like all of you have been listening very well to what Lois and Bella mostly have been saying. So really well done, everyone. Think about that as you think about your disclosure plan. So this is part of a holistic plan. So write these things down, keep them on your computer somewhere, and start thinking about how you can start implementing on these particular areas. So I'm going to stop sharing that there. Only 22 of you actually shared your thoughts. If you have more thoughts you want to share, you can still put them in there, but write them down for yourself at least. Have a think about that as you're developing your disclosure plan. Great. So that actually brings us to the end of that long unit, but I think really deep and dense unit that is really the basis of the standards. Now we want to talk about that implementation. So Lois, now that people know where they want to go, how do they start working on it?
Yes, indeed, Tiffany. We've talked so much about what to report. We all know now the detailed content required for disclosure, but I think the question on many people's minds will be, well, how do I do it? What practices and processes do I need to be able to make my disclosures according to the ISSB standards? So we're going to have a look in this module at three things. First of all, how to identify sustainability related risks and opportunities. Secondly, Tiffany will take us through in the evaluate section, which will look at scenario analysis amongst other things. And thirdly, integration will look at how you can integrate sustainability related processes and practices into your existing processes and practices. So let's start with identifying sustainability related risks and opportunities. Well, just to remind us, IFRS S1 asks companies to provide material information on all sustainability related risks and opportunities that could reasonably be expected to affect a company's prospects. And S2 sets out the requirements for climate. So, but what about risks and opportunities beyond climate? Well, S1 specifically directs companies to sources of guidance that can support the identification of risks and opportunities and information to disclose about them. First, when identifying which sustainability related risks and opportunities to report on beyond climate, S1 says that companies must, i.e., they shall, consider the applicability of the SASB standards. These are the industry-based standards. And those SASB standards are available to see from the IFRS Foundation website. So you would look on a sector-specific basis at the SASB standards, which set out the risks and opportunities most likely to be material to your sector. So they're a very good starting point, which you are required to use or to consider according to IFRS S1 and S2. So a company may also consider educational material. Then the ISSB has issued educational material on sustainability related risks and opportunities and the disclosure of material information. So again, a very relevant piece of material to look at as you consider which risks and opportunities you might want to report on. They also allow companies to consider the CDSB framework, application guidance, and this covers a variety of topics, including water and human rights and forests, etc. You can look at industry practice, perhaps developed by the industry association to which you belong, and you can refer to the materials of investors-focused standard setters like the integrated reporting framework. So once you've considered which risks and opportunities might be relevant to look at, then what information do you report? And same sources of information should be considered. But in addition, companies can look at the GRI standards and, if appropriate, European sustainability reporting standards. Now, you probably remember that we saw this reflected in the example from CLP when they reporting on waste management and material use. This is exactly what they had done. Let's have another look at an example now from IALA. And this is more about their process for identifying risks. So in all cases, they start with communication and consultation to give themselves a kind of an overview of what different stakeholders internally and externally think about the risk landscape, if you like. Then their first step is to establish the risk context. So they look at internal and external factors to consider the risk landscape and the context in which they operate. Secondly, the second step is to assess the risk, to analyze and evaluate it. Third, they decide what treatment to apply to the risk. And finally, they have a monitoring and review process. Now, in each case, you can see that the company describes the output they intend to get from each of these steps. So in the case of monitoring and review, they will use that to update their risk portfolio and risk management report. So we see the connection there between the sustainability related risk and opportunity process and how that's integrated into the risk management process. And we see who is the owner, who is in charge of that particular part of the process. Let's have another look now at identifying risks and opportunities in an example extract from a company called Nest, which is based in Finland, and it's a producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. So it's using science and technology to transform waste and other resources into renewable fuels and circular raw materials. In this extract from the company's annual report, you can see how they have used scenarios to help them identify risks and opportunities. They've looked over a time horizon to 2050. The net zero world scenario anticipates that the intention will be to limit global warming to 1.5 degrees C above pre-industrial levels. And there's a variation on that below the net zero EU and North America by 2050. And the reason these two are slightly different is, of course, because different jurisdictions and markets will develop their climate responses and strategies at different paces. So in the case of the net zero world divided by jurisdiction, the company identifies risks and opportunities. And they also use a compromised climate scenario for contrast. And in that case, climate action is slow and global warming of 2.5 to 3 degrees is expected. And you'll see that they also give us an indicative financial impact of the risks and opportunities that they've identified. And perhaps understandably for this company, the most positive financial impact is in the net zero world 2050, because in that case, the company expects opportunities for accelerated global demand for the solutions it offers, and they'll have opportunities to leverage global reach, expand into new markets, and optimize the way in which their products are used. So a case in which scenarios have informed risk and opportunity identification and indicative financial impacts. We've already talked about this, so I won't go into detail, but the ISSB recognises that it can be difficult to identify risks and opportunities related to sustainability because of all of the different uncertainties involved. So they tell us that a company is required only to use all reasonable and supportable information available at the reporting date without undue cost or effort. We've seen this phrase before. But what does it mean? Well, reasonable and supportable information is specific to the company, so should be known to the company. It takes account of the external environment, and we saw that in the Ayala example. It includes information about past events and current conditions. The company will know about those, but also can take account of forecasts. And perhaps that's what Nest was getting at by using scenarios to inform their understanding of risk and opportunity. And in some cases, what's proportionate is specified by ISSB standards. So Tiffany's going to take us through the evaluate part of this module now.
Great. Thank you very much, Lois. So once risks and opportunities are identified, companies then need to evaluate the financial effect of those risks and opportunities. And this can often be the most daunting when first starting. So we will briefly review a few key concepts that help make this process easier. So first, resilience and addressing uncertainty. So to help investors understand a company's resilience against climate risk, S2 requires a company to disclose information about the implications of climate change on its strategy and its business model. So it also asks for the company's financial and operational capacity to adjust or adapt over the short, medium, and long term. For example, you might test your company's resilience against new regulation to limit certain high emission activities, for example, or your company's ability to respond to changing crop yields due to more frequent heat waves. So to do this, you will use scenarios based on science and analyze how these scenarios will lead to the company's incurring effects. Now, a lot of you wanted to work on scenarios as you move forward, so hopefully we can share a number of useful resources today to get you started on that. I think the most important thing to remember is a scenario analysis does not require you to predict the future. I mean, I guess none of us can do that, can we? But it is a tool to test your resilience as a company against various different potential future events. So S2 does not specify which scenario a company should use in its analysis, but it does require a few things of the company. First, to use relevant scenarios and provide information about the scenarios it has selected. Second, to provide information about other relevant assumptions that have been used in the scenario analysis. And third, S2 includes guidance on how a company can determine its approach to scenario analysis. Now, this encompasses a range of practice from qualitative scenario narratives to complex statistical modeling. So considering this, the ISSB standards require that a company is using an approach that's commensurate with the company's circumstances, and that they're using all reasonable and supportable information that is available to the company at the reporting date without undue cost and effort. That's just to say what Lois was just explaining before related to proportionality. So do what you can to the best of your abilities. Let's use an example again to bring light to that. So we're now looking at Nestle. This is a Swiss multinational food and drinks company many of you may be aware of. Here we see one output from their climate scenario analysis from their 2024 non-financial statement. So this visual you see shows the potential impact of specifically physical climate changes on yield of 12 of their key agricultural commodities for 2040 under a medium emissions scenario. So the modeled metric is the projected percentage change in crop yields up to 2040 compared to the baseline of 2022. So the analysis projects that increased heat waves, increased droughts, and water stress could affect the availability and also the quality of key raw materials that could in turn lead to increased price volatility and input costs as well. So yield reduction for some raw materials may affect supply chain stability. So their disclosure then goes on to summarize the key outcomes of their analysis for different aspects of their businesses and the key steps that they're taking to improve their resilience or their preparedness. In response, the company has set out potential effects on their business model, their business resilience, on their strategic and their financial planning, and also their product innovation, operational efficiencies, and R&D initiatives. For example, indicating how they're leveraging science to prepare for this, and also discussing engagement and advocacy. Now let's talk a little bit about our discussion about the future. So anticipating the materiality of information about possible future events can also be particularly challenging. So to help with this determination, IFRS S1 asks you to consider a number of issues to help you with that determination. So you could think of it as a list of identifying all the steps and information you need to come to your judgment on whether something is material or not. So for example, companies should be considering all low probability but high impact events. So maybe they're not very likely to happen, but if they do, they really affect you. Those should be considered. Any uncertainty related to the company's cash flows should also be evaluated. And another important point here is the need to reassess uncertainties at each reporting period. Doing it once isn't enough. Things change, right? We haven't predicted the future. We're moving forward in it. So we have to do that reassessment. The ISSB doesn't require you to do a scenario analysis kind of every reporting period, but rather a scenario analysis can be done in line with your company's strategic planning cycles. And as you're adjusting your strategy in the normal cycles you normally do that, you should be reconsidering that scenario and relooking at that assessment again. Great. I hope that gives a few tips to move forward on scenario analysis and key implementation areas. I'm going to pass back to Lois now to take us through the last section of this unit.
Yes, thank you, Tiffany. And actually, this is where we've got good news for everybody, because the good news is that you probably have a lot of processes and practices and systems within your organization that can help you with your disclosures and to support your disclosures. So let's have a look at this in some detail. As you look at what you've already got, you'll need to be thinking about whether what you have is entirely appropriate for sustainability related disclosure, whether it needs development or whether you need something entirely new. So you can start with a gap analysis, check for gaps in your existing systems and processes. Also look at the suitability, both of the process and the criteria used in the application of those processes. So we all know that sustainability related risks and opportunities manifest over longer term time horizons, are much more uncertain. So you might want to add criteria to your processes beyond probability to cover things like likelihood, impact, vulnerability, and speed of onset. As we've seen in some of the examples, companies are linking their internal controls, compliance, and risk management systems. So you can look at how controls might be used to support your sustainability disclosure. Importantly, who, which contributors, which departments, which people internally and externally have information, systems, processes, expertise that can help you. So make a list of all the contributors and departments from whom information and systems might be available to help you. You'll need to think about interconnections between different internal and external factors and how they might affect your processes. What are the uncertainties associated with sustainability related risks and opportunities, and what process will you use for managing those uncertainties or responding to them? What resources are already in place, or what might you need to apply for? Do you, for example, need to go through a change management process or a budget application process? Now, these things, of course, with the ISSB standards being focused on disclosure itself, these things are not covered in the ISSB standards. That quite understandably, they're outside scope, and that's why we refer you there to a resource from WBCSD, which gives more information on these types of considerations from a practical point of view. Now, because of this, we have suggested to you that you develop a disclosure plan as your non-mandatory homework. Now, a disclosure plan I always think of as like a central record that helps you answer certain questions about your own reporting goals and objectives, how you'll manage them, what audiences you want to communicate with, who will be involved, which departments and individuals, how will they be organized? What will their responsibilities be? How will you source data? Where will you get it? Can you use existing systems and controls? Will any of your processes or your outputs be assured? And if so, by whom? And what will be the sign-off procedures for your sustainability disclosure? And so really developing a disclosure plan that records all of these things helps you take control of your narrative. It's your company, you're being asked to make disclosures about your strategy, your risks and opportunities, and having a disclosure plan helps you take control of that, helps you to support internal collaboration, knowledge sharing, cross-functional team discussions, And I think most importantly, to create this central reference point and audit trail that shows where and how judgments have been made, where data's been sourced, who's been involved, etc. All the things we've talked about. So let's have a look at an example here from Novo Nordisk, the Danish pharmaceutical company, at what they say in their 2024 annual report about the basis on which they have prepared their sustainability report. So this extract outlines, amongst other things, the regulations, standards, and practices the company has had to or has chosen to use for developing its statements. And you'll see that there's a long list here: the Greenhouse Gas Protocol, the Science-Based Targets Initiative, the GRI, the laws to which this company is subject, and so on and so forth. So we can see how they have prepared their statements on sustainability. They also tell us what time horizons they've considered for the sustainability statement. They define what they mean by short term, medium term, and long term. They tell us how estimates have been used and where to find more information about assumptions and uncertainties. They tell us about what changes have been made in preparation and presentation from previous periods are due to specific circumstances. So there's a lot in this small extract and a lot more in their report. And those of you that have done financial statements will be familiar with this approach to describing the basis on which the statements have been prepared. And you can imagine, can't you, that collecting all this information before you start the reporting year is going to be really helpful. It'd be awful to have to do it during or after the reporting year. So let's have a look at a Zoom poll now. And this asks, is a disclosure plan required by the IFRS Sustainability Disclosure Standards? So you can either answer yes, and you must disclose your plan, or no, but it's a very helpful tool. So we'll give you a moment to think about that. One more moment. Let's end the poll there and I'll show the results. And you can see, wow, look at that, 50-50. Well, yes, I mean, so in a way, shows how difficult it is to answer this. Those of you that answered no are correct. And those of you that answered yes aren't entirely wrong, because although there is no requirement in the ISSB standards that says you must have a disclosure plan and you must disclose details of it, there are specific requirements that say that you must describe the methodology that you have used, or let's say in the case of judgment, for example, I think this is paragraph 74 of IFRS S1, you're required to explain how judgments have been made, in the face of uncertainty. So, and with your greenhouse gas emissions, you must disclose what methodology you use. So there are some things that are specific, but there's no requirement to have a general disclosure plan. But we really think it will help you if you do it, and that's why we're recommending it for your voluntary homework. So let's do one more Zoom poll now. This will be an easy one. I think you'll all know the answer to this. And that is, a disclosure plan can help a company take control of its narrative, support collaboration, act as a reference point and audit trail for disclosure preparation, or skip full disclosure as prescribed by the ISSB. Let's see what you think of this one. We're nearly at the end of module 3. Thank you for sticking with us. And in the interests of time, sorry to rush you all, I am going to share the results now because I can see you all know the answer. Of course, it does all these 3 things. And as you rightly concluded, of course, it is no excuse to skip full disclosure as prescribed by the ISSB. So well done, everyone, for that. And Tiffany's going to take us through the Module 3 summary now.
Great. Thanks, Lois. So that's a wrap to this third module. So let's just, before we close out, remind ourselves of a few key things. So firstly, firstly, I should change the slides so that you all have something to follow along with. I want to come back to those connections. So in the last module, we wrapped up by highlighting the importance of connections between the four core content areas of disclosure. We then learned in this module that there are many connections as well between a company and its external and internal environment. So these connections are what we need to focus on to identify key risks and opportunities. Now, the second thing we discussed in this module was related to evaluating those risks and opportunities, and key components of that evaluation is consistency in your assumptions. So scenario analysis can be a very helpful tool as it helps keep track of those assumptions. And if you're new to this, a reminder that there are pre-packaged scenarios, such as those from NGFS, that can provide you with the assumptions that can be used for evaluation of financial effects. Now, scenario analysis is actually required by S2 for climate-related resilience assessment. And then finally, don't start from scratch. So as we've seen, even if some of the data is not data you're already disclosing, you may already be collecting it for different reasons, or you may have the appropriate practices or processes in place to collect the data. You just need to expand the data you're collecting. So you just need to make slight adjustments in some instances. Don't look to start everything from scratch. Now, let's take a moment to come back to our disclosure plan with our next activity. So this activity, and I'll share my screen again, is looking at what practices and processes you might look to update and make use of that already exist in your organization. So this really builds on that idea of not starting from scratch. So have a think about it. I can see 73 are in the Menti, but none of you have responded. So think about what are kind of existing systems or existing practices that you might have in place that you can just make adaptations to and adjust so that you can collect data needed for the IFRS S1 and IFRS S2 standards. So the first answer is a long one. It says quite a few things, actually. You can use existing financial, operational, risk management, procurement, HR, compliance processes. These can all be adapted, and that's totally correct. All of the practices and processes that you have in place could indeed be adjusted to collect new information related to sustainability. And ideally, you should look at how to make those adjustments rather than, thinking of everything from scratch. Just making sure that they actually meet the needs and collect the data actually required by the IFRS S1 and S2. We see here risk reports and finance and risk. Linking with existing KPIs, certainly, especially in that strategy component, making sure this links well with your strategy, internal processes, indeed, risk registers. Yeah, you're already evaluating risk. So it's making sure that we have the right horizon and that our vision is including all those sustainability and climate related risks as well. Customer and stakeholder satisfaction reports, definitely, and collect data center sustainability reports to derive ours. So maybe working with partners to learn from their risks and opportunities, adoption of data management tools. And many of them you're probably already using. So I think you guys are off to a great start here. Some things that I think I would highlight that you can look at building on already is your existing enterprise risk management processes. We're talking a lot here about managing risks and opportunities. So you can include sustainability related risks and opportunities into existing ERM or enterprise risk management processes and practices and teams. Also, you probably already have certain data management tools in place. I see a few have been mentioned here by everyone, but you might be using XBRL. You can continue to use the same software and tag ISSB taxonomy, as we'll hear about from Robert in the next section. And other tools you might be using. It could be as simple as Excel. These are tools you can still use here. And then another important point that I'd note here is governance structures. Last time someone mentioned that one of the areas you wanted to work on or needed to enhance was your governance structures. It doesn't mean that you need to, create everything from scratch here either. You can use the same governance structures, for example, that were set up for TCFD, and then it can be adapted for what we're looking for in ISSB S1 or S2. Or maybe you have a risk committee that can integrate sustainability related aspects into what they work on. So again, just a reminder that we don't always have to start from scratch here. So I'm just going to come back to our slide deck now, and we're going to come back to our last unit. And so please, Robert, you've been sitting so quietly in the background answering all of our questions. So thank you for being here. I'm going to pass to you now for the last unit.
Yes, thank you very much, Tiff. Thank you guys for the questions. Indeed, there's quite a few really good ones. So happy to help and answer as much as I can. And so welcome everyone. My name is Robert Svetowski. I'm a partnership manager at the IFRS Foundation, and indeed I will walk you through. We go together through the last module of this training, which focuses on communication and also on the location, on when and where in the terms of the disclosing sustainability related financial disclosures. So these are the main sections in this module: location and timing, efficiency, and confidence. So let's get started. Let us get started with talking about the location, and to clarify what are the requirements in the standards on where sustainability disclosure should be located. But before we get into the specific requirements of that element, it might be helpful to think again, zoom out a little bit, and think about sustainability disclosure in the context of a complete reporting package that is useful to investors. So, as we already previously mentioned a couple of times, the requirements in the ISB standards are based on addressing the information needs of investors and effectively build on past standards and frameworks, such as TCFD and SASB, which are similarly focused on investor information needs. So these are the foundation, or where we're coming from. So, and one of the major advancements of the ISB standards is to bring rigor of accounting and focus on connectivity of the financial statements. So the ISSB and GRI standards, for example, do share some content requirements. That is what the information to report. They differ in terms of overall objectives. So as I said, the ISSB standards are really focused on investor information needs and decision making, and that's information that could reasonably be expected to affect companies' cash flow, access to finance, and cost of capital. And that in comparison to GRI, the GRI is to elicit information about companies' impacts regardless or whether or not these impact a company's financial performance. So this is important distinction between those two frameworks and perspectives. So as a result, the ISSB and GRI take a different, although complementary approach to materiality. And in practice, the GRI approach is probably more commonly understood among sustainability practitioners, whereas the IFRS is more likely be familiar to accounting professional and finance executives. So in summary, many of the impacts traditionally identified as material in the GRI standards may give rise to sustainability-related risk opportunities. that are likely to affect a company's prospects, and therefore investors would need information about them. So you have to remember that the impact should not be ignored, and as long as they rise to the um, to the risks which may affect companies' prospects, they should be taken into account. So you will find some additional information about potential areas of focus for primary users and that is investors in your handouts. So now we mentioned that before, we're moving to the materiality and the definition of materiality here as well. This is important. And you already probably come across various references and different types of materiality based on different reporting standards and frameworks. So it's helpful here to briefly again recap what we mean by material information when it comes to the ISSB standards. As we discussed in the first module, information is material when it influences decision of primary user of general purpose financial reports, in other words, investors, and informs decisions about things like providing resources to a particular company, buying, selling, or holding debt or equity instruments, granting loans or other forms of credit, as well as voting on or influencing how management uses a company's economic resources. So if these elements influence decisions on those aspects, then these are relevant material information. So when preparing disclosures, the key consideration here is characteristic of the investors and the company own circumstances. So what I mean by that, for example, different investors have a different and sometimes conflicting information needs, and therefore the intent of sustainability related financial disclosures under ASB standards is really to meet common information needs of investors. And this is really about the key information that an average investors will be looking for. So you'll not be able to satisfy all information needs of all the investors. You need to find some sort of a middle ground and some area where this will be indeed required by any average investor. So the important thing to remember is that materiality is a characteristic of information. So we're not talking about material risks in the context of the ISB standards. To be really technically precise, we're talking about the materiality of the information. So the ISB standards take this two-level approach. So first, you need to identify sustainability-related risks and opportunities that is based on what would investor expect to affect the company's prospects and company's prospects. So the first step is identification of those risks and opportunities, and then on this second step, the next level would be to disclose material information about those risks and opportunities which investors need in order to make a decisions. So this word material is only happening or being mentioned in this second step, where you think about what material relevant information you need to disclose about those identified risks and opportunities. So now, when it comes to disclosing material information under S1, requires that information be clearly identifiable and that information itself is clear and concise. So what it really means in practice is that material information shouldn't be obscured by other non-material information. For example, by information that a company disclose on the basis of, say, another framework that is not centered on the information needs of investors, but maybe focuses more broadly and includes different types of stakeholders. So why is it important? Well, first, the location of sustainability-related financial information with a general purpose financial reports may vary between companies across different jurisdictions. And second, information designed to meet the needs of other stakeholders beyond investors might be provided voluntarily or to meet regulatory requirements. So the potential problem here, and this is both allowed, of course, that we do allow we don't specify exactly where the disclosures needs to be located. We're also, using this building blocks logic allow and to provide any other additional information. But where the problem potential may arise is that material information reported under ISB standards could be obscured because it might be buried amongst other information that has been prepared for different purposes or according to different objectives that don't necessarily align with the ISB requirements. So this could be problematic in case where reports are perhaps poorly organized in terms of content and therefore material information is scattered throughout the report. So again, it's important. This is important because a company won't be able to assert compliance, which we'll talk about later what that exactly means, with the ISB standards if a report is overloaded with irrelevant data or if it blends information for different audiences without clearly identifying the information that is material to investors. As mentioned previously, IFRS Foundation has published education material back in 2024 on this topic to really help provide additional guidance for companies on identification and disclosing material information. So do check this out for additional detail by following the link in your handout. All right, and we'll have a quick poll here, and this is something to check your understanding of these things we were been talking in the last few minutes. The question is, information should be disclosed in the annual report when applying ISB standards if, and what are the requirements or the questions you should be asking yourself. If omitting the information could reasonably be expected to influence investor decisions, it could reasonably be expected to affect companies' cash flows, it exemplifies the values of the leadership team. So let's see. What is your understanding of this? I have this straight after what we said, that should be fairly straightforward. Okay, I'll end the poll now. Yes, most of you get it right indeed. It's about influencing investor decisions and also affecting the company's cash flows. Yeah, this information will be then relevant for investor needs, and this is where the information should be disclosed. It's not really about exemplifying and underlying the values of leadership team. So answers A and B are correct in this case. All right, and then let's answer really the question on which we asked at the beginning of this section. So, where to report for ISSB? So, the standards must be made, the disclosures must be made available at the same time on the and on the same terms as the financial statements. This is the part of and so in that case they form and they are the part of the same general purpose financial reporting package. So that said, IFRS S1 does not have requirements that specify the exact placement of that information. And this just means that the ISB standards don't specify where within the overall reporting package the information has to be provided. And it's really by design in order to give some flexibility and accommodate different jurisdiction-specific requirements on the location of the reporting. The most important factor, though, is that we need to ensure that sustainability disclosures are for the same reporting entity as the related financial statements, and again that they are disclosed at the same time as the financial statements covering the same reporting period. And it's worth noting that standalone sustainability reports are not prohibited by the ISB standards, provided that the report forms the part of general purpose financial reporting package. So, for example, a company might choose or might be required to have, by local jurisdiction, to have a distinct separate sustainability report that is issued alongside of broad annual reporting package. And in practice, it is where the use of cross-referencing plays a really important role. So the cross-reference information must be available on the same terms and the same time as the sustainability-related financial disclosures, as I've already mentioned. And importantly, the complete set of disclosures must not be made less understandable by including information by cross-reference. So the cross-reference information also becomes a part of a complete set of disclosures, excuse me, made under ISSB, and such must be compliant with all the ISSB requirements, including things like being relevant, comparable, verifiable, and timely. And to understand this better, I'll pass over to Tiff for an example.
Great. Thanks so much for that, Robert. As usual, I think these examples help bring it to light a little bit. So rather than sharing one example here, we wanted to provide an overview of current practices on where companies are reporting information. And this draws from a report we shared earlier, the World Business Council for Sustainable Development, or WBCSD's 2025 Reporting Matters, an annual review of corporate reporting from a selection of global companies. So this example doesn't just tell you what one company's doing, but it tells you what a bunch of companies are doing, taking a bit of a high level report or a look at it. And you can see the full report in the chat there. Thanks, Fiona. So while standalone sustainability reports remain the predominant approach in 2025, they comprise 54% of reports in the year sample. Combined reports have increased by actually 11%. So this confirms that there's a shift towards reporting financial and non-financial information within the same document in line with mandatory requirements. The increase in combined reports of putting all information in one report, combining financial and non-financial disclosures, such as annual reports or financial statements or universal registration documents, is linked to the regulatory shift in Europe, according to the publication. In the region, 42% are actually combined reports, up a staggering 24% from 2024. Then standalone sustainability reports do still predominate in the Americas, representing 81% of reports. And in APEC, there is a mix of sustainability and self-declared integrated reports at 58 and 35%, respectively. So this is also a useful publication you can refer to for more corporate reporting examples. So you can use that link in the chat, or it's also linked to in the slide deck so that you can look at some extra examples on your own time. Back to you, Robert.
Yes, thanks, Tiff. Right, we'll be moving now to next element, something which we mentioned before, and the role of technology, and yeah, we will explain what the ISB taxonomy is. So, we'll be talking here about digital reporting, but before that, let's also explain what in this context an ISSB taxonomy really is. So, of course, you might have had the word taxonomy before, and in general, it's a word for the classification system, and often companies will have their own internal taxonomies that essentially help to define key terms across business or functions. You may also have come across the reference to a taxonomy in the context of sustainable finance taxonomies, such as the EU taxonomy, but also a growing number of countries that have developed green taxonomies, that these are often core components of the broader sustainable finance framework. And what these taxonomies do is that they essentially help to classify different types of economic activity or investment as sustainable. But this is not exactly what we be talking here. Because when we talk about ISSB taxonomy, we're actually referring to something different. It still means a type of classification system, but it refers to one that is used to categorize information within a report. And in this world of AI and the push for digitalization, you've probably seen a shift or transition away from traditional PDF formats and increasingly towards information on web pages contained with structured data sets, such as the databases offered by stock exchanges or regulators. So recognizing this digital shift, the IFRS Foundation has developed the ISSB taxonomy, which is essentially a machine readable digital tagging system published in April 2024 with the overall intent to help investors analyze sustainability reports. And the taxonomy does this by essentially translating the requirements of S1 and S2 into standardized data tags, which facilitates the digital reporting and makes it easier for investors and data platforms to take large data sets, like information from the entire industry, for example, and bring them all together for analysis. Now, the ISSB taxonomy is not mandatory for compliance with the ASB standards themselves, but rather the taxonomy is designed to support the digital submission of the ASB disclosures, which comes with the several benefits. So we'll be now moving to the next section. And we'll talk about efficiency. So following the discussion on location and timing, we wanted to spend a bit of time talking about efficiency, what actually, and we added this for the training because we often hear that the companies that they face a growing report burden. What we hope is to highlight here that when applying the standards correctly, there are a number of ways in which the burden can be reduced. So what does effective communication actually mean here? What does it look like? So often companies, if they put all the information that they have into a report, that everyone will be satisfied. But that will be against the core requirement in S1, which is the third presentation, which means that a completely set of sustainability related financial disclosures under ISSB should present fairly all sustainability related risks and opportunities that could reasonably be expected to affect entities' prospects. So it's not about putting everything about sustainability into report. It's about presenting, again, material information, meaning that it's complete neutral and provides an accurate depiction of risks and opportunities that companies face. So the information should be clear and concise. And we'll be now spending some time talking about what does it mean the quality of the information. What does really entail? So accountants in the audience are probably very familiar with the rigor, with the strictness required when it comes to the data collection, oversight, sign-off, and even external assurance that is associated with the preparation of general purpose financial reports. And this whole concept is a very strong internal and control environment is really well understood. So that, in comparison, sustainability information has not traditionally been prepared under the same type of control environment. And because of this, the SB standards really do focus on elements of quality. So very briefly here, we talk so how to ensure that the information is of the high quality. So that is among other elements, it's will be connected to providing comparative information from the previous reporting period, as well as the requirements that deal with restatements and that need to restate comparative information or amounts for prior periods disclosed in the case of material error. And again, focusing on quality, companies should also avoid unnecessary duplication and can achieve this through cross-referencing, which we were discussing before. And last but not least, also when aggregating information should be aggregated if it has the shared characteristics and disaggregated if that's not the case. And it's really about ensuring that the material information is not obscured and such that information shouldn't be aggregated if doing so would indeed obscure material information. So we talk about it when we mentioned before, so I'll be here also very short on it. You might notice that when disclosing your putting together your disclosure, there might be some overlap in the topics covered and the information disclosed across different reports or section of the reports. So in order to uh, avoid duplication, S1 actually requires companies to avoid to avoid this unnecessary duplication. So, for example, if the company has the same governance approach for all sustainability issues, then it will be then required to disclose it once. And so, for the climate-related risks and opportunities, are governed at the same as the other sustainability-related risk and opportunities. This information should be disclosed as a whole and only once. How that can be achieved in practice and maybe better understood, we have a short example here. Over to you, Tiffany.
Thanks, Robert. We're a little bit behind. I want to make sure everyone has time to go through the resources. So I'm not going to go into this example in detail, but I do recommend going to the slide handout where we have this example from ArcelorMittal, but also a number of other examples that you can use in your own time. What I will review with you is a few mechanisms that support adoption. So Lois had already touched on these proportionality mechanisms in the last section, so I won't go too far into detail, but a few main things to review. So many requirements in S1 and S2 are to be applied proportionately, which again recognizes that companies will have a range of capabilities and preparedness on these issues. So for example, qualitative scenario analysis is permitted, and we had a question on this earlier, and you'll see the phrase all reasonable and supportable information as at the reporting date without undue cost or effort or commensurate with skills and capabilities and resources in a number of places. So just a reminder that this should be applied proportionately to your organization. Also, the ISSB standards specify certain transition reliefs that companies can make use of for in the first year. So for example, these transitions include being able to limit disclosures to climate in the first of application of ISSB standards. So you might have seen that before. Also, there's a relief that relates to companies not needing to provide disclosure about Scope 3 GHG emissions, nor apply the GHG protocol corporate standard to measure emissions if they're already using a different measurement approach. So just want to flag this so that you're aware that it's not an all at once. There's different reliefs you can use and you can apply. I'm gonna skip our next two polls. I'm sure you'd all get it right, to be honest. You're a very clever audience. And I'm gonna take us to our last unit here and back to Robert so that we can finish on time for all of you. Thanks, Robert.
Thanks, Tiff. Okay, right. Yes, we are behind, so then let me quickly go through this important section and we'll be again talking a bit more about comparative information, as it is important trust building, showing data and trends over time. So as such, IFRS S1 requires the companies to disclose comparative information for the preceding period for all the amounts disclosed. This relates to qualitative or narrative information as well. So why comparative information is so important? It really helps to emphasize the context and allow the companies to demonstrate relative progress over time, as well as communicating changes or evolution to company strategy and risk management processes. Also, metrics disclosed by the company might be redefined or replaced over time. So just to note here that revision or restatements are not only necessary when there is a risk of a material are only necessary when there is a risk of material information being omitted or misstated or obscured because of not revising or restating comparatives. So also in regards to the material errors, if that's what had happened, in this situation, the company is required to restate these errors in the comparatives provided. So please refer to the standards and further to the handouts to read more about this important considerations. So moving to the statement of compliance, we touched upon it before, and this is to in order to have the full compliance of the of this to the standards that need to be explicitly stated in your disclosures. So it's important to emphasize that the company can still make a statement of compliance. It has decided to make use of the transition reliefs in the first year of reporting, the one Tiff was talking about, and also if the company is using a proportionality mechanisms. Just to shortly signal here that there are two exceptions when information required by the standards could be omitted that would still allow a company to make statement of compliance. As these exceptions relate to firstly, commercially sensitive information, and secondly, when a law or regulation prohibits disclosures. And please go again to the standards and refer to them in order to find out more about these two exceptions. In the interest of time, I'll not begin covering them in detail. So to conclude, it's importantly companies that are beginning to phase in the ISB standards voluntarily and therefore are only partially aligning to the standards. These companies would not be able to make explicit statement of compliance. So there is a link we'll be sharing you there is a link on the slides, and I'll be sharing in the chat as well, which will take you to the guide that the foundation published in 2024, and it's about the voluntary application of standards, when we can read more about what is required. Thanks, Fiona, for posting this. So things to remember, just to conclude, you need to ensure a couple of things or elements when putting together your disclosures. First, you need to ensure that the information follows the requirements of fair presentation. So that's what it's defined in conceptual foundation of the S1. So that's certain characteristic the information has. So it should be relevant and when it's material, and it should faithfully represent what it says it does by being complete, neutral, and accurate. So there are also enhancing characteristic of the information to complement those. So the information should be comparable, verifiable, timely, and understandable. And another key element is to ensure that investors can understand connection between information disclosed, between risks and opportunities, between the financial statements and sustainability statements, and the four content areas. And finally, that's what we were talking here as well, that the disclosure should be for the same reporting reporting period, and for the same reporting entity. These are the key takeaways from this module. Over to you, Tiff.
So much, Robert. Oh, I accidentally just pushed a button that was allowing me to draw on the slide, which is not what I was wanting to do. But I'm going to skip past our module summary, but do please take a quick read of it, remind yourself of a few of the things that Robert was just reviewing with you anyways. And we're just going to take a real quick moment to go to the mentee so that we can get your thoughts on two things. Now, I don't have much time for this activity, but someone's already introduced their thoughts. Feel free to introduce any others you have. But just to wrap up that activity, the homework assignment, The last area I wanted to look at is how are you going to present this information? Sometimes reports can be 50 to 200 pages long. Maybe they're not that easy to navigate. How do we make this information easy to find, easy to read? Someone said, flow charts or a simple roadmap. Yeah, we have to remember that, even though AI are increasingly reading reports, there are still people reading these reports. So we have to make them easy to digest. Also, I think something that's really important to recognize when we're putting information in a report is it also helps us reflect on it. So if we can't put it into a simple, summary or a simple diagram, then maybe we've skipped some logic here and maybe there's something missing. So these different tools to improve the usability of your reports can also make sure that the content of your report, it flows, it connects, it makes sense. So things like clear table of contents and hyperlinks going back in to make those connections, a navigation pane in the panel, or creating digital reports can all be super helpful. Now, with that, I really want to hear from all of you. Now, how comfortable are you with these tasks? So at the start, we asked you how comfortable you are with explaining to team members what is the ISSB, using the ISSB, and developing sustainability reporting strategy. So at the start, you guys were all around the 2 mark, 2.5, I'd say. So the first person's already moved that up a little bit. We see a few more have moved that up. I would love to hear from all of you about how comfortable you are with all of these tasks. It also really helps us understand how we need to improve our training and whether or not you've achieved these objectives. Now, keep in mind, you have all of the resources that we've shared with you available. So hopefully your comfort level continues to grow as you start using all of these resources. Now, that Mentimeter is going to keep running. So please use the link in the chat. Please continue to input your information there. We'd love to hear from you. But I'm going to go back to the slides with the last few minutes we have just to share with you a few really important resources. Great. So as a reminder, you do have your homework, but it's not mandatory. We really recommend you spend some time to think it through, though, and draft a disclosure plan. And we do ask you in the feedback survey if you've done that. Now, we've mentioned it time and time again, but please make use of the IFRS Knowledge Hub in your continued learning. There's things like the FSA credential, the IFRS Sustainability Alliance, and licensing all available also through the IFRS's Foundation's website. As we mentioned, the IFC's Beyond the Balance Sheet tool is a great one-stop shop to receive more guidance on sustainability, disclosure, and ESG. We've already mentioned the toolkit. Please make use of that and all the guidance in there. Another, suite of guidance and easy tools you can use. Now, in our last minute, just to share with you all the certificate of participation. Now, we do require you to fill in a feedback survey. It's a Google survey, so it's possible that your organization might block it. We suggest just, doing it on your phone then perhaps, or on a personal computer. Once you fill in the feedback survey, you'll receive a certificate within maximum 1 week. So give us a few days to make sure we have time to develop those certificates and send them out to you. If you missed the link in the chat, don't worry. We're going to email it to you. Everyone who participated in the Zoom will get an email tomorrow sometime with the link to the feedback survey as well. Just ending off with some thank yous. Thank you to all of the SSE official supporters. These supporters make all of our work possible, and they show that they're truly committed to sustainable and transparent capital markets. If you or your organization would like to become a supporter, please just reach out to the SSE initiative. And we couldn't have made this session possible without Sally and her team at AFCM. Thank you so much to the Arab Federation of Capital Markets for hosting us today, and to our colleagues at the IFRS Foundation, IFC, and my colleagues at the SSE. Thanks to Lois and to Fiona for being here today. And thanks all of you. Thanks for joining us. We hope this was helpful, and we hope that you can start your journey now with all of these tools and resources. Have a great afternoon, evening, wherever you might be, and we hope to see you again soon. Take care.